Hello, all my dearest students of CA Final Full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So today we are going to start with our revision of transfer pricing, one of the most important topic which is 100% going to come in your examination, which is also important for your practical life as well. So let us start with the comprehensive revision in full English of the topic of transfer pricing. Now all the provisions of transfer pricing are given under section 92 to 92F. So it's a small topic actually if you see the number of sections, but yes, content wise it is a very big topic. There are very few sections in this topic, but every section has huge content. So 92 to 92F has all the provisions of transfer pricing. Now the very first section of transfer pricing, that is section 92, talks about the charging section of transfer pricing, which means when transfer pricing is applicable under the income tax law. In that they have put three subsections: subsection 1, subsection 2, subsection 3. Subsection 1 says that if you earn any income, if any income is arised to you, then you should compute, and income is arised from international transaction, then you should compute your price as per arm's length price. So if there is any income which has arised from international transaction, then you should compute the arm's length price. What do you mean by the term income? Income may include sale also, income may include purchase also, income may include expense also, income may include interest also. All these things are income. Income can be impacted because of all these things. Income can be impacted because of sale. Income can be impacted because of purchase. Income can be impacted because of expenses. Income can be impacted because of interest expense also. So any income which is arising from international transaction. What do you mean by international transaction? The definition of international transaction is given under 92B. There we will see what is the meaning of international transaction. So any income arising from international transaction shall be computed as per arm's length price. What do you mean by arm's length price? In simple words, arm's length price means genuine price, but technical definition of arm's length price is given under 92C. We will see that in 92C in a while. Now, this section is not only applicable for international transaction, but it is also applicable to certain specified domestic transactions mentioned under 92BA, which we will see later on. Majority of the provision, majority of the chapter is important from the perspective of international transaction. But yes, transfer pricing is not only applicable to international transaction, transfer pricing is also applicable to certain domestic transactions, not all, to certain domestic transactions, which we will see after some time. Now, transfer pricing is also applicable if there is a cost allocation and apportionment between associate enterprise. There is one company and there are multiple subsidiaries across the nation, and they are developing some product and they have incurred some cost. Now they want to allocate the cost or apportion the cost between all the entities. The cost allocation and apportionment should also be done as per arm's length price. This is what 92 subsection 2 says that. Now 92 subsection 3 is a very important subsection. What does this say? This says that transfer pricing is not applicable if after applying the transfer pricing the income of the assessee reduces or the loss of the assessee increases. So after applying the arm's length price, if the income reduces or the loss increases, it means after applying the arm's length price, it is beneficial to the assessee, then transfer pricing is not applicable. So after applying the transfer pricing provision, it should not benefit the assessee. It should benefit the department. If it benefits the assessee, transfer pricing is not applicable. How it benefits the assessee? By reducing the income, by increasing the loss, transfer pricing not applicable. I hope it is clear to all of you. Now, one of the most important conditions for applying transfer pricing is the relationship between two entities. When an entity enters into a transaction with another entity, both the entities should be associated enterprises. If both of them are associated enterprise, then only transfer pricing is applicable. Otherwise, transfer pricing provisions are not applicable. Now, the question is, what do I mean by associated enterprise? It is defined in section 92A. And there are around 11 to 12 cases. If you fall in either of the cases, you can say that the two enterprises are supposed to be an associate enterprise. Let's see all the 12 cases one by one. All the 12 cases shall happen at any time during the previous year. If at any time during the previous year any of the activity is happening, you are associate enterprise. It is not necessary that the 12 conditions should concurrently be following throughout the 365 days. Not necessary. If all these 12 conditions, either of the 12 conditions has happened even for a moment during the previous year, then you both are associate enterprise. First, when one enterprise holds 26% or more voting power in another enterprise. So if I hold 26% or more voting power means equity shares. If I hold 26% or more equity shares in another entity, we both are associate enterprise. Second, I am Mr. A, there is Mr. B, there is Mr. C. If I hold 26% equity in Mr. B, and if I hold 26% equity in Mr. C, then B and C will also be considered to be associate enterprise. So if A holds 26% in B and if A holds 26% in C, therefore B and C will also be called as associate enterprise. Point number 2, it is mentioned. Now in point number 1 and 2, the relationship of 26% can be direct or indirect. Direct means A holds 26% in B, A and B are associate enterprise. Now A holds 80% in B and B holds 40% in C. A holds 80% in B and B holds 40% in C. So indirectly A is holding in C 32%. 40% of 80%. Therefore indirectly A is holding in C how much? 32%. Therefore A and C are also what? Associate enterprise. Indirect holdings are also covered. Direct holdings are also covered. Point number 3, let's come to one of the most important point, one of the most commonly asked point. If I finance 51% of the book value of your assets, if I finance 51% of the book value of your asset, then we both are associate enterprise. So what I am supposed to take? I am supposed to take your book value of assets and then I am supposed to take how much I have given as a loan. If that comes to 51% or more, we both are associate enterprise. Now, fair market value of asset is not important. What is important is book value of asset. Condition number 4. If I guarantee at least 10% of the total borrowings of your company or your enterprise, then we both are associate enterprise. Condition number 4. Whatever is the total borrowing, if I give at least 10% of that, we both are associate enterprise. Condition number 5 itself has 3 points. Condition number 5 itself has 3 points. Suppose I am one company, you are another company. If I appoint more than half of the directors of your company, or if I appoint more than half of the members of the governing board of your company, we both are associate enterprise. If I appoint more than half of the directors of your company, or if I appoint more than half of the members of the governing board of your company, we both are associate enterprise. Second criteria, if I appoint just one executive director of your company, we both are associate enterprise. Third criteria, if I appoint just one executive member of the governing board, we both are associate enterprise. Just one executive member of the governing board. For normal director and for normal member, it should be more than half. For executive director and executive member, just one is sufficient. Next. Point number 6. Point number 6 is cross-holding. I am Mr. A, there is Mr. B, there is Mr. C. I am A Limited, there is B Limited, there is C Limited. If I appoint more than half of the directors of B Limited, and if I appoint more than half of the directors of the C Limited, B and C are associated. If I appoint more than half of the members of the governing board of B Limited, and if I appoint same year also, both of them are associate enterprise. If I appoint one executive director here, both of them are associated. If I appoint one executive member here, both of them are associate enterprise. Any combination of these 4 items, if I appoint in B, if I appoint in C, B and C will become associate enterprise. Check it please. Point number 7. Point number 7 talks about the situation where you are dependent on the intangibles of the other person. So if I am wholly dependent on the intangibles of another entity, I am wholly dependent on the know-how, patent, copyright, trademark, license, franchise of another enterprise, then me and that entity will be considered to be deemed to be associate enterprise. But the dependency has to be wholly. If it is partly, then associate enterprise is not possible. To make associate enterprise possible, the dependency has to be wholly. Next, raw material dependency. If out of total raw material, 90% of the raw material I purchase from you, 90% of the raw material I purchase from you out of total raw material, then I and you will become associate enterprise. If I am dependent on 90% of raw material from one entity, then that entity and me will be associate enterprise. Next one is slightly dangerous point. Goods are manufactured by me and I sell to you. I'm making some goods and then I'm selling to you. But the price and other factors are influenced by you. You will decide the price, you will decide the credit period, you will decide how the delivery will be made, you will decide how the warranty will be given, everything will be decided by you. So the transaction is influenced by you. So how will we come to know? That will be mentioned in the agreement, that it is influenced by the buyer. Therefore, I and you will become associate enterprise. Check it please. Point number 10. When one enterprise is controlled by individual, I am an individual, I control one enterprise, and another enterprise is controlled by me or my relative or jointly by both of us. So one enterprise is controlled by me in India, and in outside India, another enterprise is also controlled by me or my wife individually. Then me and that enterprise will become associate enterprise. I hope it is clear to all of you. Next, HUF is carrying on business in India, and the member of the HUF and the relatives are carrying on business outside India. So HUF is carrying on business in India, and outside India there is one enterprise in which the member of the HUF or the relatives of the members of the HUF have formed one enterprise. So my HUF and that enterprise will be deemed to be associate enterprise. And last but not least, I am a partnership firm, I am an AOP BOI. If any person has 10% stake in my partnership firm or my AOP BOI, then that person and my firm will become associate enterprise. Just 10%, who holds 10% or more in my entity, then that partner and my firm will become associate enterprise. And last but not least, if CBDT wants, they may prescribe few more cases. As of now, they have not prescribed anything. If they want, they might prescribe few more cases. As of now, there is no more prescribed, no more prescribed items. Only 12 items are prescribed as of now. If you fall in any of the 12 items, you are said to be what? Associate enterprise. To apply transfer pricing, having associate entity relationship is extremely important. Without that, transfer pricing is not possible. Now let's talk about international transaction. Because what is written in subsection 1? Any income arising from international transaction shall be computed based on arm's length price. So what is international transaction? There are 2 points in international transaction. Subsection 1 talks about the definition of international transaction and subsection 2 talks about the definition of deemed international transaction. First of all, let's talk about basic international transaction meaning is what? Sir, what do you mean by the term international transaction? International transaction, first of all, can be called as international transaction if it is entered between 2 or more associate enterprise. The transaction has to be entered between associate enterprise and one of the parties should be non-resident. One of them should be non-resident. Sir, can both be non-resident? Yes, both can also be non-resident. Then you have to prove that the transaction is taxable and accrued in India. Sir, can both be non-resident? Both non-resident is possible. Sir, one of them can be non-resident. Yes, one of them can also be non-resident. Sir, can both be resident? Both resident, not possible. If you want to make a transaction international, one of them should be non-resident. Both resident, not possible. And then the transaction should be in the nature of what? Purchase, sale. You can write as many points as you want, not very important to remember. Lease, transfer, use of intangible, tangible property, provision of service, nature of capital financing, borrowing, lending, guarantee, business restructuring like amalgamation, demerger, slum sale, etc. You can do any of them. All these are different natures of transaction. Now let's talk about what is deemed international transaction. Deemed international transaction has been put under section 92B subsection 2 with some intention, where the assessee is trying to evade tax. Now pay attention please. X is in India and Y is in Australia and X and Y are associate enterprise. Now if they enter into a transaction whether transfer pricing will apply, the answer is yes, because both of them are associate enterprise and one of the parties non-resident, Y is non-resident. So what they are doing? They are not doing transaction with X. They are doing transaction with Z, which is an unrelated party, and they are entering into a prior agreement. They are saying that X will sell some goods to Z and Z and Y will enter into a prior agreement that whatever goods will be sold by X to Z, Z will sell it to Y ultimately, and the goods will ultimately go to Y in Australia. So therefore, you are trying to indirectly evade tax, indirectly evade transfer pricing provisions in India. So therefore, the law made a provision. What provision? If any entity enters into a transaction with third party and the third party already has a prior agreement with your associate enterprise. If you enter into a transaction with third party like Z and that Z already has a prior agreement with your associate enterprise, then the transaction between you and that third party will be deemed to be international transaction. And in that, one more catch is that the residential status of Z is not relevant. If Z is non-resident, then also it is deemed international transaction. If Z is resident, then also it is a deemed international transaction. This is the only exception under the entire income tax law where X is also resident and Z is also resident. Still transfer pricing is applicable. Both are resident. Generally, I told you now, one of them should be non-resident. But in this exceptional cases, even if both are resident, still transfer pricing provisions are applicable. I hope it is it is understood to all of you. Now we will talk about computation of arm's length price. Because again in 92 subsection 1 what is written? Any income arising from international transaction shall be computed having regard to the arm's length price. So if transfer pricing is applicable, you have to compute the arm's length price. Sir, what is arm's length price? Arm's length price in general terminology means a genuine price. But what do you mean by the term arm's length price in the context of income tax law? So you have to understand 92C and its rules now. Now in 92C there are 4 subsections. The very first subsection says that the arm's length price of the international transaction or the domestic transaction has to be computed by the assessee himself having regard to the most appropriate method. The law has given 6 methods. You have to select best method out of you which is the most appropriate for you. Sir, how will I select the most appropriate method? Depending upon your nature of transaction, class of transaction, nature of associate enterprise and many other factors, functions performed, asset employed, many factors you have to analyze and find out which is the best method out of all 6 methods. But you have to select the most appropriate. We are not giving you option to select any one which you like. You have to select the most appropriate which is applicable in your case. The 6 methods are not given as a choice that select any one out of them. No. You have to select the most appropriate out of them. So which are the 6 methods? Comparable uncontrolled price method is the first method. Then resale price method, cost plus method, then profit split method, transactional net margin method, and last one is any other method which CBDT may prescribe. The last one is not very important. The CBDT will prescribe on case to case basis. If you are not able to classify your case in the first 5 methods. Once you select the method, then you have to apply the relevant rules and find out the arm's length price. You have to find out the arm's length price. Department is not going to find out the arm's length price first. First, assessee will find out the arm's length price. Okay, understood, sir. After that, you file the income tax return, and then the AO has the power during the pendency of the assessment. The AO has the power to determine the arm's length price if you do any of the four things. If he finds you doing any of the four things, he has the power to determine the arm's length price by issuing you a show cause notice. Sir, what four things that I should not do that so that AO should not interfere in between? First, he should not be of the opinion that the price charged and paid is not as per this section. He should not be of the opinion that you are not follow the rules properly, you are not follow the subsection 1 properly, you are not selected the most appropriate method properly. He should not feel that. He should not be of that opinion. Second, you should always maintain proper documents and information as per 92D. If you don't maintain proper documents and information as per 92D, then the AO will determine your arm's length price. Third, for determining arm's length price, you should use the data which is very reliable and correct. You should not use non-reliable or incorrect data. I always say that. You should not take the data from Google or ChatGPT, etc. You should take data from registered entities. I have told you some registered entity in class like Provise, like Capitaline, etc. These are registered entities from whom you can take transfer pricing data. You can purchase the data. Those are authentic data. And fourth, if the AO or CIT appeal ask for the information in 92D subsection 3 and you do not reply to them within 10 days and along with extension within 40 days, 10 plus 30, then also the AO has the power to determine your arm's length price. If any of the four things has happened, AO will issue you a show cause notice. He will give you an opportunity of being heard and he will determine your arm's length price. He will determine your arm's length price. Now let's take an example to understand the fourth subsection. Suppose the total income of the assessee. Suppose the total income of the assessee is 300 lakhs. The transaction price is 100 lakhs. And you have deducted TDS of 10%. This is royalty, for example. So you have deducted TDS 90 lakh rupees and you have paid 90 lakh rupees to other person. The other person has shown 100 lakh as his income. Now pay attention please, very important factor. Now the AO says that no, it is not 100. It is transfer pricing. The expense is not 100, it is only 40. So I have to increase my total income to say 360 lakhs. Because earlier I have claimed 100 lakhs as deduction. Now I have to claim only 40 lakh as deduction because the AO is saying that only 40 lakh is correct price. Therefore I have to add back 60 lakhs. Therefore my income will increase by 60 lakhs. My income will become 360 lakhs. Now consequences. What I cannot do. Whatever income is increased by A over here because of the change in arm's length price, on that income I cannot claim 10AA. I cannot claim chapter 6A profit link deduction. On this increased income I cannot claim 10AA deduction. On this increased income I cannot claim profit link deduction. These two things are not possible. Secondly, today I am paying how much? 100 lakhs I am paying to my associate enterprise. 10% I have deducted. He is showing 90 lakhs as income, net income, gross income 100 lakhs. Now that other person cannot say that my income is also 40. My income is also 40, so they reduce this or cancel this 40 and my income should also be taken as 40 and already 10 lakh has been deducted as TDS, so give me refund. Refund will not be. Other person income will not be recomputed and refund will not be granted to him. So whatever income has been increased by AO in 92C, on that much income you cannot claim deduction under chapter 6A and 10AA, and the other person also cannot claim refund of that much amount. The other person has to show the income as 100 lakhs only. I hope it is clear to all of you. This is a very important point. These 2 points are given under proviso to 92C subsection 4, first proviso and second proviso. You may not remember the proviso, it's okay, but I'm just telling you. Now we will talk about the methods, the 5 methods. In all there are 6 methods, but the 6th method is case to case. So generally there are only 5 methods relevant for us in exam. The first method is the comparable uncontrolled price method. In this it is very simple. See, certain terminologies you need to understand first and you have to remember these methods properly, and it is very difficult to explain these methods in words. You need to take some examples which I have done in the class also. For every method I have given you some examples, and with the help of examples I have explained you. Today the objective is only to revise the things. We will do a lot of questions also when we will do the compilation of 26 papers. Now pay attention please, all of you. Pay absolute attention. Suppose what I am doing is comparable uncontrolled price method. Try to understand certain terminology. If I am doing a transaction with my associated enterprise, that will be called as international transaction. And the transaction with which I am comparing, that is the third party transaction, that will be called as uncontrolled transaction. So the transaction with associate enterprise will be called as international transaction, and the transaction with third party will be called as uncontrolled transaction. Now, step number 1 in comparable uncontrolled price. You need to find out the price charged or paid with respect to uncontrolled transaction. That is, find out the third party price. So third party you are selling for 3,000, to your associate enterprise you are selling for 2,000. So take 3,000 as base price and then find out the functional difference between both of them. And whatever is the functional difference, that you have to add and less. In what? In the third party price. In the third party price you have to add and less the functional differences. Then you will get your arm's length price. Very simple method, nothing great as such. Next method is very important. Resale price method. Very dangerous method. In this, again, in every transaction, in every question, there will be two transactions. In resale price method, there will be two transactions. First, where you will purchase the goods from associate enterprise and then you will resell to third party. Transaction number 1, purchase from associate enterprise, resell to third party. Transaction number 2, purchase from unrelated, sell to unrelated. First one, purchase from associate entity, sell to unrelated. Second one, purchase also from unrelated, sale also to unrelated. So what is step number 1? Step number 1 is when you purchase, transaction number 1 is step number 1. When you purchase from associate enterprise and sell to third party, at what price you resell, that is your step number 1. Purchase from associate and sold to unrelated party, at what price you have resold, take the step number 1 as that resale price. Then find out the GP margin of second transaction. When you purchase from unrelated, sell to unrelated, what is the GP margin? That much GP margin you have to reduce from your price number 1. Then you will get your cost. Okay. So while taking the price, you will take the price of the first transaction resale price. While taking the GP, you will take the GP of the second transaction. Now after that you have got the cost. Now when you purchase in the first transaction, after purchasing you might have incurred some purchase related expenses. After purchasing you might have incurred some freight, you might have incurred some customs. That also you have to reduce from your cost. And then you have to compare both the transactions. What are the functional differences? Discount is there, warranty is there, etc. Accordingly you adjust. And then you will get your arm's length price. First and the second step is very important. Third method, profit split method. Profit split method is used when you do generally a joint venture with multiple entities. Suppose there are 3 entities which are doing some project and they are earning some profit. Now how the profit will be split between them? So first of all, find out the combined profit of all of them. Suppose the combined profit is $10,000. Now you have to divide this combined profit into relative contribution ratio. Sir, what is relative contribution ratio? That will be given in the exam, don't worry. That will be identified based on FAR analysis, function, asset and risk analysis. That will be identified based on who has put how much effort in this particular transaction. So suppose the relative contribution ratio is 50%, 30%, 20%. So step number 1, find out the combined profit, $10,000. Then step number 2, find out the relative contribution ratio. Now divide the profit into this ratio, 50, 30, 20. So 10,000 divided into 50, 30, 20 is equal to 5,000, 3,000, 2,000. Now give 5,000, 3,000, 2,000 to everybody. And they will add this 5,000, 3,000, 2,000 to their cost. Profit will be added to their respective cost and you will get your arm's length price. As simple as that. This method is not very important method for examination. Okay. Now coming to cost plus method. This method and the next method is the most important method for the examination. Be very careful. One of the most important methods which are very commonly asked is cost plus and transactional net margin. Now there is a great difference between these two methods and the previous 3 methods. In the previous 3 methods, we were making adjustment in the price. You can go and check. In first method, you are making adjustment in price. Second method also you are making adjustment in price. Third method also you are making adjustment in price. In fourth and the fifth method, you are not making adjustment in price. You are making adjustment in margins. In the fourth and the fifth method, you will make adjustments where in the margins you are going to make adjustment. How, sir? Let's see. Cost plus method. I am in India. I am selling some goods to my associate enterprise on cost plus some margin. I am also selling some goods to third party. So I need to find out the arm's length price of the transaction which I am doing with my associate enterprise. So step number 1, find out the direct and indirect cost with respect to associate enterprise. So whatever is the direct and indirect cost with respect to associate enterprise, find out that first. Okay. After that, when I am selling to the third party, what is the GP markup in that case? So the cost you will take of whom? Step number 1, the cost you will take of your associate enterprise and the markup you will take of the third party. And then you will adjust in the markup. You will adjust in the markup, add less, you will find out a revised markup. And that markup you will add to your cost and then you will get your arm's length price. So again I am saying the cost you will take of your associate enterprise, the markup you will take of third party, and that markup you will adjust, find out the functional difference between both of them. And then after doing the functional differences, then whatever the revised markup will come, that you will add to your cost. That will give you your final arm's length price. Transactional net margin method. What is transactional net margin method, sir? In practical life, maximum people use this method only as their transfer pricing method. Here also there are 2 parties. One transaction I am doing with my associate enterprise, another transaction I am doing with my third party. You need to find out the margin of your transaction and margin of third party transaction. The margin can be net profit upon sale, net profit upon cost. But sir, when to take sale in the denominator, when to take cost in the denominator? The law is saying take the relevant base. Take the relevant base. Relevant base means what? I have told you in the class. If you are exporting, if you are selling, take the relevant base as cost in the denominator. And if you are importing, if you are purchasing, then take the relevant base as sales in the denominator. I have mentioned in the note below. This entire line is not there in the study material. So students are confused when to take cost, when to take sales. It's very simple. If you are exporting, take cost. If you are importing, take sales. Sir, logic I have told you in the class that you have to take the denominator as an untainted denominator. So if you are selling, the sales will be tainted. Therefore, take cost as untainted. If you are importing, then the purchase cost will be tainted. Therefore, take the sales as denominator. So step number 1, find out the margin with respect to a source enterprise. Then step number 2, find out the margin with respect to uncontrolled transaction. Then adjust the margin. Here also margin will be adjusted. See if there is any functional differences, both of them. Then adjust the margin. After the margin is adjusted, use that margin to find out the arm's length price. I hope it is clear to all of you. So this is what this 5 methods are all about. Along with this, there is one 6th method also, which the CBDT may prescribe on case-to-case basis if you are not able to identify your arm's length price properly. But that is not relevant for our exam. Now, coming to the very dangerous paragraph. Very dangerous provision. It is very difficult to explain this now in words. I have given you all these things in class in great detail. There are multiple questions on this issue in your textbook also, in your question bank also. In all our batches of regular batch, exam-oriented, practical question batch, in every batch, I have discussed this provision in great detail. What is this provision? Now, see, whenever I have to compute my arm's length price, I have to compare with someone. Okay. So when I compare with someone in the market, there are multiple prices that I can get in the market. Obviously, if I am selling this pen, there are many other people who are selling this pen in the market. So which price I should take? There will be always more than one arm's length price. There are hundreds of people who are selling this pen in the market. There are hundreds of people who are selling this pen in the market. So whose price I will take? So it is bound to happen that there will be multiple arm's length price in respect of one transaction. So if there is more than one arm's length price, then you have to follow rule 10 CA. Rule 10 CA will tell you the mechanism in which how you are supposed to compute the arm's length price, and that mechanism is called as range concept. First of all, range concept is applicable to whom and not applicable to whom. Let me tell you that. Out of the 6 methods, the range concept is applicable only to 4 methods. It is applicable to cup method, it is applicable to resale price method, it is applicable to TNMM, and it is applicable to cost plus method. Range concept is not applicable to profit split method and the 6th method. It is not applicable. It is only applicable to 4 methods. Plus, the number of entries that you get in the market should be at least 6 or more. Then only range concept is applicable. Otherwise, range concept is not applicable. These 2 things you have to keep it in mind before going ahead with the concept of range concept. So to apply range concept, your method should be either of the 4 methods I have told you. And in that also, to apply range concept, you need to have at least 6 entries from the industry. 6 entries where similar transaction is done by people with their unrelated party. At least 6 company data should be there. 7 is okay, 10 is okay, 15 is okay, but at least 6 has to be there. So cup method, resale price method, cost plus method, and transaction net margin method. In this also, for cup method, you have to take only current year data from the market. But for rest of the 3 methods, you have to take current year data and last 2 years data and average it. For cup method, you have to take only current year data, and for rest of the 3 methods, you have to take current year and last 2 years average. So let's talk about TNMM. In case of TNMM, what should I? Sir, is TNMM, is range concept applicable for TNMM? Yes, range concept is applicable for TNMM. Range concept is only not applicable for profit split method and 6th method. Range concept is applicable to TNMM. So in TNMM, sir, what is the margin that we take? OP upon OC, operating profit upon operating cost, or operating profit upon operating sales. So suppose we are selling, we are exporting, so we will take OP upon OC. So what should we do, sir? Go to the industry and find out at least 6 companies. At least 6 companies who are doing similar transaction and who is doing transaction with unrelated party, and find out their OP and upon OC for current year and last 2 years. So I have got the data of 7 companies, sir. OP upon OC of 7 companies. Great. If you have got the data of OP upon OC of 7 companies, that's great. Find out OP, find out OC of 7 companies of current year and last 2 years. And then do what? Add OP of last 3 years, current year and last 2 years. Add OC of current year and last 3 years and find out a percentage. Find out margin. I want at least 6 margin. 7 is also okay. 8 is also okay. 10 is great. 20 is great. At least 6 I want. Sir, I have 7 companies data. Great. Find out 7 margins of unrelated party. And then lay down those margins in ascending order. First of all, find out the margin individually and then lay down in ascending order. And then take 35% of 7. 35% of 7. If that is coming to fraction, all these things are mentioned over here. I am not saying this all from my side. Please take what? Check here. 35%. Where it is written? If it is a fraction, then take the data of the next number. So 35% of 7 is obviously fraction. So take the data of next number. So 35% of that is coming to some 2.45 something. So take 3. Then take 65% of 7. 65% of 7 is coming to something 4 point something. Then go to the next number. Take 5. Then 3 to 5% is your range. 3 to 5. On 3, check how much percentage there, and on 5, how much percentage there. That is your range. If you are within that range, great. Nobody will ask you anything. But if you are outside that range, then you have to find out median. Median means 50% of 7. Again, 50% of 7 is 3.5. It is a fraction. Go to the next number. Next number is 4. Add 4. You have laid down 7 items. Add 4. Whatever is the percentage, that will be your arm's length price. Sir, what if these numbers are not fraction, but if these numbers are whole number? If these numbers are whole number, then you have to make slight changes. Suppose number of items you have collected from the industry is 20. So what is 35% of 20? It is 7. Now this is the whole number. Now don't take next number directly 8. Now take average of 7 and 8. That will be your first number. Again, 65% of 20 is how much? 65% of 20 is 13. Again, it's a whole number. Now take average of 13 and 14. So whatever is the range, that will become your arm's length price. If you are within this range, the department will accept. If you are outside this range, the department will tell you to compute the median, and that will become your arm's length price. This is what this provision is all about. Sir, what if the number of items in the industry is less than 6? Then range concept is not applicable. Then what should we do? You should do only one thing, then take arithmetic mean of all the prices. If you have only 5 prices or 4 prices or 3 prices in the industry, then take the arithmetical mean of the 3 prices, 4 prices, 5 prices. To apply range concept, you need to have at least 6 companies data. So if it is less than 6, take arithmetic mean and then compare with your actual price. If the difference is up to 3%, ignore. If the difference is more than 3%, then this price will be applicable. Suppose the arithmetic mean is coming to 103 and your actual price is 102, then ignore 103. Take 102 actual price. But if the arithmetic mean is coming to 103 and your actual price is 95, now the pricing difference is more than 3%, now you take 103 as arm's length price. I hope it is clear to all of you. This is what the range concept is all about, and Rule 10CA is applicable. Rule 10CA is applicable when, again I am saying, it is applicable when there is more than one arm's length price. So you have to follow the range concept for 4 methods. Okay. Now, there are some issues over here. One is the Supreme Court judgment and second one is a bright line test concept, which I will be saying now. So what does the Supreme Court judgment say now? See, generally we know that we have done in the chapter of appeal in our classes that ITAT is the last fact-finding authority. If you want to go beyond ITAT, there has to be question of law. So now the question is whether the High Court has the power to determine the arm's length price. Whether the High Court has the power to determine the arm's length price, because determination of arm's length price is a question of fact. It's not a question of law. So here the Supreme Court has given a very beautiful judgment. The Supreme Court has said that no, High Court does not have the power to determine the arm's length price, but yes, High Court definitely has the power to interfere and say that whether the arm's length price has been determined as per the income tax law and its rules or not. Whether the interpretation of law has been done properly or not, that High Court can definitely say. Because ultimately arm's length price is determined as per 92C and its rules, and it's a law. So High Court has the power to interpret the law and say and interfere between the SSC and the department and say that yes, the arm's length price is not properly computed as per the Income Tax Act and its rules. That power High Court has, and nobody can stop the High Court from doing this. Therefore, by default, High Court cannot determine the facts of every arm's length price, but High Court can definitely say that the arm's length price is computed as per the rules, as per the law, or not as per the rules, not as per the law. That power High Court definitely has. I hope it is clear to all of you. Next is a very global concept not applicable in India, bright line test. We need to understand first of all what is this bright line test with an example. Suppose there is a company by the name called as Sony, which is in Japan. Now Sony has opened a subsidiary in India, and Sony has told its subsidiary in India to do massive promotion in India in the form of advertising, marketing and promotion expenses, AMP expenses. So Sony is in outside India, Sony parent is in Japan, and Sony India is in India. And Sony India is doing what? Massive advertising, marketing and promotion expense. So there is a concept of bright line test in many countries outside India. where the subsidiary in the home country is doing some promotional expenses, then all the promotional expenses should be categorized into two parts, routine and non-routine. Routine expenses will be allowed as deduction. Extra non-routine expenses will not be allowed as deduction as per bright line test. Now, this bright line test concept is not there in India. Still, the assessing officer is applying this bright line test on Sony India and even on Bosch and Lom India, etc., and many other companies. So the Delhi High Court has held that you cannot apply the concept of bright line test in India in the absence of machinery provision. There is no computation mechanism in India to divide what is routine and what is non-routine. There is no concept of bright line test in India to divide between this much is routine, this much is non-routine. The advertisement, marketing and promotion expenses incurred by the Indian subsidiary is not an international transaction. Therefore, transfer pricing cannot be applied on that transaction. The advertising, marketing and promotion expenses is done with third party, not with associate enterprise. Therefore, transfer pricing cannot be applied in this case. I hope it is clear to all of you. Is it clear? Now, let's talk about the next provision. Reference to TPO. Very important section. Some important amendments have also been made in this particular section. Reference to TPO. In this, there are three parties. Try to understand the three parties first. I am an assessing officer. You are an assessee. And there is a transfer pricing officer sitting over here. Sir, who is the transfer pricing officer? A transfer pricing officer is nothing but an assistant commissioner, deputy commissioner or joint commissioner of income tax who has been empowered to do this job, who has been empowered to do the transfer pricing matters. So I am an AO, you are an assessee, and there is a TPO. I am doing your assessment and I am computing your international transaction arm's length price and domestic transaction arm's length price, and I am having some issues in computing the arm's length price. So I have the power to refer your arm's length price to TPO. Before referring, I will take a previous approval of commissioner and I will refer the arm's length price to TPO. I can refer international transfer pricing also. I can refer specified domestic transaction also to the TPO. Then TPO, before doing that, before referring the transfer price, referring the computation of arm's length price to the TPO, I will take commissioner approval. After that, the TPO will send you a notice and will ask for the information. Will ask you to produce information. TPO himself will also gather some information. Now, some very important issue. Suppose I have referred TPO that, sir, I am not able to understand the arm's length price of this royalty. Please try to find out the arm's length price of this royalty. So the TPO will identify the arm's length price of this royalty. Now the question is, if TPO suo moto wants to find out the arm's length price of some other transaction also, like FTS, like purchase sale, can he do so? The answer is yes. The TPO has been given the power to find out the arm's length price of other transaction also which are not referred to him. So he can find out the arm's length price of the transaction which is referred by AO and also which is not referred by AO. I hope it is clear to all of you. So after that, the TPO will do that. TPO will gather all the evidence from the assessee. TPO will also gather all the evidence from its own end, and then he will pass an order in writing. The order of TPO will be given to the AO and to the assessee, and the order of the TPO will be binding on the AO. Whatever the TPO will be saying, AO has to follow that. By when the TPO will pass the order, sir? He will pass the order at least 60 days before the completion of assessment due date. What is the completion of assessment due date? I will tell you very clearly. For previous year 25-26, assessment year 26-27, the by default time limit to complete regular assessment, best judgment assessment is 12 months from the end of relevant AY. So 12 months from the end of relevant AY from AY 26-27 will be 31st March 28. Now, because you have referred the matter to TPO, you will get extra 12 months. Because if the matter is referred to TPO, the assessing officer gets extra 12 months. Therefore, 31st March 28 will become 31st March 29. So 31st March 29 will become the last day to complete assessment. At least 60 days prior to that, TPO should pass an order. At least 60 days prior to that means the TPO should pass an order by 30th of Jan 2029. So if the TPO passes the order till 30th Jan 2029, you can say that the TPO has passed an order at least 60 days prior to that. I hope it is clear to all of you. Now, in that also, in this entire process, if the proceeding is held by any court, if the proceeding is put on stay by any court because of which the time is lost, suppose the court has put your proceeding on stay for 40 days, or if the assessing officer is asking information from foreign authority, therefore the assessments are stopped now in between for 40 days. So therefore, the TPO and the AO will get extra 40 days time, and after that also, whenever the proceedings will be resumed, after that they should get at least 60 days time to complete the proceedings. So first of all, if the proceedings are kept on hold because of court stay or because of the information they are going to get from foreign authorities, say it is kept on hold for 30 to 40 days, say 30 days. So whenever it will be resumed, you will get extra 30 days, and after that, whenever it will be resumed, you will get extra 60 days. Even after excluding this 30 days, at least 60 days more should be there to complete the proceeding in your case. Now, TPO is ultimately a human being. While passing the order, the TPO can make a mistake. Yes, if the TPO makes an apparent mistake, the TPO will rectify the order under 154. The TPO will rectify its order under 154. Now, because the TPO has made a mistake, therefore the assessing officer would have also made a mistake. Why? Because TPO's order is binding on the assessing officer. So, if TPO has made a mistake, AO has also made a mistake. So, if TPO rectifies, even AO has to rectify the order under 143, 144, 147. Even AO has to rectify their assessment orders. Then TPO has been given some extreme power to issue summon, to call for information, to conduct survey also. And last but not least, this proceeding will also become faceless now. I hope it is clear to all of you. This proceeding will also become now faceless. No need to physically present in front of the TPO. Now, one very important amendment has been made in Finance Act 2025. What is that amendment? Suppose previous at 25-26 is going on, 26-27 AY is going on, previous at 25-26 assessment is going on, and in this assessment the TPO has determined the arm's length price of your royalty as 100 crore rupees. Listen carefully. So for previous at 25-26, if the TPO has determined the arm's length price of your royalty as 100 crore rupees, so now the TPO has passed the order. Now you feel that it is correct, so you can tell the assessing officer next year onwards that please, for next 2 years also apply this particular TPO's order. Don't refer for the next 2 years. For the next 2 years also apply this same price for royalty. I am happy with this price. So that will reduce the litigation. That will unnecessarily reduce reference to TPO again and again in multiple years. In 1 year, if the AO has referred and AO and the TPO has found the arm's length price for a particular transaction, say royalty, and in second year and third year also, if the assessee accept that, it will reduce the time, it will reduce the wastage of time for everybody, for me also, for assessee also, for AO also, for TPO also. So let's see now. The ALP determined for an international transaction as per 92 CA for any previous year shall be similar, but this provision is not applicable for block assessment. For block assessment people, this provision is not applicable. This is applicable for regular income escaping best judgment assessment, not for block assessment. So again I am reading. The ALP determined for international transaction or SDT as per 92 CA for any PY, say previous at 25-26, shall apply to similar transaction, say royalty, for 2 consecutive PYs immediately following such PY. Our PY is 25-26, so 26, 27, 27, 28 also you can apply. A new subsection has been inserted to provide that ALP being determined in relation to international transaction under subsection 3 for a PY shall apply to similar international transaction or STD for 2 consecutive PYs immediately following such PY and fulfillment of certain conditions specified therein. Okay, now this is repeating only. Now, how to opt for this? You have to file an option. You have to file a form. The assessee shall be required to exercise an option in prescribed form, manner and time period. So what is that form number? I don't know. By when I should fill that form, that I don't know. Time limit will be prescribed by the law. I don't know what is the time limit. This option cannot be exercised in case of block assessment. In case of search cases, this option is not valid. Now, after you give an application to the TPO will pass an order within 1 month from the end of the month in which the option is exercised and declare the option as valid subject to prescribed condition. So once you make an application, TPO will declare the option as valid, and for the next 2 years also same arm's length price will be applied in your case. No need to refer again and again. And once the TPO declares the option exercised as valid in respect to an international transaction or SDT for any previous year, for 2 consecutive previous year immediately following such previous year, for such 2 previous year, now the AO will not refer for TPO. So for the next 26, 27 and 27, 28, AO will not refer to TPO. And if he has already referred and then I made an application, he has referred first and then I made an application, then he will cancel the reference. He will cancel the reference. He will stop that particular proceeding and he will accept my what? He will accept my price for the next 2 years. Then TPO's order will be given to AO and then AO will pass the final assessment order, etc., all these things. And that will be done within 3 months, nothing great as such. So the rule is very simple. Whatever the TPO has said for the current year, you have an option. Department does not have an option. Assessee has an option to tell the department, please apply for the next 2 years. For that, you have to fill a form. Once you fill the form, the TPO will pass an order within 1 month, declare your application as valid for the next 2 years. And then for the next 2 years, no fresh reference will be made by the AO to TPO. I hope it is clear to all of you. So let's go ahead with the next part now. Then the next part is a very important part for examination, which is very recently inserted. It was not applicable for the last 8 years. After 8 years, the institute has introduced this particular concept in your exams. And that is safe harbor rule under 92 CB. What is safe harbor rule? Now, safe harbor rule is applicable in 2 cases. One, it is applicable in case of transfer pricing cases, and another it is applicable in case of determination of income under section 911, that is in case of business connection. So first we will talk about the safe harbor rule in case of transfer pricing, and then we will talk about the safe harbor rule in case of business connection. So what is safe harbor actually? Safe harbor is nothing but the government is giving the associate an option in case of certain businesses. If you fall in case of that business, then you should show some margin which the government will tell, and if you show that one margin, we will not question your price, but you have to show that much margin to the department. For that you have to fill a form 3 CEFA, etc. That CEFA form can be filled for 1 year, 3 years. That procedure we will say in a while. Secondly, even if you fill this form and opt for the safe harbor rule, you have to maintain two things. You need to maintain documents under 92D, and you have to fill form 3CB, that is 92E has to be fulfilled. You will not be relieved from documentations and filing of form 3CEB, that is the report, audit report. That you have to do. Yes, your transfer pricing arm's length price will not be questioned. So first of all, we need to find out who are those fortunate people for whom this benefit is available. Let's see one by one. The very first fortunate people is, what all things we are supposed to remember, sir? You are supposed to remember the nature of business. You are supposed to remember the transaction value. You are supposed to remember the margin. These are the three minimum things you have to remember. After that, whatever you want to remember, you remember. The very first thing, provision for software development services. First of all, what is software development services? It is defined under the income tax law. What all things are there under the software development services, sir? Sir, are we supposed to remember that? I'm not saying you have to remember, but at least you need to know, have an idea about what all items are coming inside that. Like software development service includes business application or information system development using known methods or existing tools. Support for existing system, computer language conversion or translation. They may put, instead of directly putting the word software development service, sometime they will play with you and they will put the SSC is engaged in computer language conversion. So that it indirectly means the SSC is engaged in software development service. The SSC is engaged in computer language services. Is the safe harbor rule applicable? You have to say yes. Safe harbor rule is applicable subject to other conditions. Adding user functionality, system debugging. I have explained you the meaning of all these things in the class if you remember. Existing software adaptation, user documentation preparation, but does not include research and development services, whether or not in the nature of contract research and development services. These two lines are separately covered in separate business. So yes, you cannot completely ignore them. Read them as many times as possible. Don't by heart them, but you have to read them. You need to have in your conscious mind. There should be a screenshot in your mind that yes, this item is there and it is covered under what? Under the definition of software development services. Once you know that it is software development services, now your operating profit margin in relation to operating expense, this is nothing but OP upon OC. This should be at least 17% if the value of international transaction is up to 100 crore, and it has to be 18% if it is more than 100 crore and up to 300 crore. So if the transaction value is up to 100 crore, then 17% should be margin. If it is more than 100 crore but up to 300 crore, then 18% margin you have to show minimum. If you show more than this, then great. If you show less than this, safe harbor rule not applicable. Sir, what if the transaction value is more than 300 crore? Then also safe harbor rule is not applicable. In this case, maximum transaction value should be up to 300 crore. If the transaction value is more than 300 crore, safe harbor rule is not applicable. I hope it is clear to all of you. Second one, provision of IT enabled services. Sir, what do you mean by IT enabled services, sir? Let's see. What do you mean by IT enabled services? That is also defined. IT enabled service is nothing but BPO service, call center service, service center service, etc. BPO services using IT, including back office. You are providing some back office services to some big company. Call center, contact center, data processing, mining, insurance claim processing, small things, not big. Legal database, medical transcription, excluding medical advice, translation, payroll, remote maintenance, revenue accounting, support center, website service, data research, integration, analysis, remote education, including content development, clinical development based, database management, excluding trials, but again does not include contract research and development services. Here also margin is same only, 17% up to 100 crore and 18% above 100 crore up to 300 crore. But I think so mistakenly ICI government has written over here aggregate. If you see all other cases, the word aggregate is not written. Only in this case aggregate word is written. Rest all it is written the value of international transaction. Nobody pays so much attention. Don't worry. You assume this to be also as value of international transaction only. Just assume same only. Don't get into the aggregate of concept. But technically the word used over here is aggregate. If you see the original law, if you see actually rule of the safe harbor rule on the CBDT website. Here also the margin should be same only. 17% up to 300 crore and above 100 crore Up to 300 crore, 18%, above 300 crore, safe harbor rule not applicable. Margin means OP upon OC. Sir, what is OP upon OC, sir? For that, you need to find out, sir, what is OP upon OC. Operating expense is your denominator. Okay. And your numerator is operating profit. So from the revenue, you have to reduce this. From revenue, if you reduce the expense, you will get your profit. Whatever is your revenue, from that you reduce your expense, you will get your profit. Sir, what does expense include? Expense will include all costs incurred in relation to international transaction. Point number 1. Count with me. Second, it will also include the ESOP provided to our employees by associate enterprise. If associate enterprise is providing ESOPs to our employees, then that ESOP cost is also included in this. Third, reimbursement of to AE. If AE has incurred some expense on our behalf and we have given them some reimbursement. Fourth, if they have incurred some expense on, we have incurred some expense on their behalf, so amount recovered from AE. So all these things are covered. Again, check. First, cost which you have incurred with respect to the international transaction. Second, if AE has provided some ESOP to your employees, then the cost with respect to that ESOP also. Third, reimbursement you are doing to AE. AE has incurred some expenses for you, you are reimbursing them. And vice versa. You have incurred some expense for AE and they are reimbursing you. You have to take these 4 things in your cost. And you also have to take depreciation, amortization relating to the asset used by the assessee. But do not include these things. Do not take financial expenses like interest, uncertain liability, pre-operative expenses like preliminary expense. Do not take forex fluctuation losses. Do not take extraordinary expenses, loss on transfer of assets. Income tax expenses do not take. Further, the reimbursement that we are getting and the reimbursement that we are doing, both of them should be done at cost. We should not add margin in that. The reimbursement that we are doing, that should also be done at cost. Whatever they have paid, we should pay them. If they have paid and they have paid 100, we are paying them 120. Take only 100. If we have paid 120, they are paying us 150. They take only 120. Don't take extra. Take only at cost. Sir, are we supposed to remember this? Don't remember all these things. But yes, nature of business you have to remember. You may forget this. It's okay. But nature of business you try to remember. Okay. Don't try to remember what is operating profit, what is operating cost. That they will directly give in the exam. Don't worry. Provision of knowledge process outsourcing services. Sir, what is knowledge process outsourcing services? Let's see the nature of business first. It is IT-based services with advanced analytical or technical skills, including geographic information system, human resources, engineering or design, animation, content development management, business or financial analytics, market research. Again, does not include any research and development, whether or not in the nature of contract research and development services. It does not include that. I hope it is clear to all of you. Is it clear? Now, coming to what? How much margin I am supposed to show. First of all, for KPO services, the transaction value should be up to 300 crore. Only one margin, one slab is there. 100, 300, multiple slabs are not there. Only one slab. The transaction value should be up to 300 crore. Okay. Second, the margin should be 24% if the employee cost divided by total expense is less than equal to 60%. So if the employee cost divided by total expenses up to 60%, the margin should be minimum 24%, not less than that. If the employee cost is 40%, but less than 60%, then the margin should be less than, it should be 21%. And if the employee cost is less than 40% or equal to 40%, then the employee cost should be 18%. I have told you in the class also that there is some mistake over here. This and this, if you read carefully, this is overlapping. This is not a mistake by me. This is a mistake by CBDT only, which I have told you in the class. Okay, if you remember. So here also 40% is coming exact. Here also exact 40% is coming. Try to remember that. Now, next one, very important. Advancing of intra-group loan in Indian currency, and the next one after that, advancing of intra-group loan in foreign currency. Let's talk about Indian currency first. But before that, let's try to understand what do you mean by intra-group loans. This is a very important definition for us. Intra-group loan means loan given to non-residents, associate enterprise. Loan which is given to only non-resident associate enterprise, not from any financial company or bank or enterprise or lending or borrowing enterprise. Plus, it does not include credit line or loans without fixed repayment. There has to be loan with fixed repayment, and there has to be no credit line. Okay, it does not include credit line. Credit line means it's kind of bank overdraft. We are giving you credit, you can withdraw whenever you want. You don't want to withdraw, don't withdraw. It should not be of that. It should be an absolute loan. So it should be a loan given to non-resident. It should be a loan given to associate enterprise. It should not be from financial company or banks or money lending business people. It should not be a credit line. It should not be a loan without fixed repayment. If it is all these conditions are fulfilled, it is an intra-group loan. Now here, the margin is nothing but the interest rate. The interest rate will depend upon your credit rating. The credit rating of the borrower will decide the interest rate. The interest rate will be SBI's 1 year MCLR plus SBI's 1 year marginal cost of lending rate on 1st April 2025 plus 1.75% if the credit rating of the borrower is AAA to A, plus 3.25% if the credit rating is BBB minus, BBB plus, plus 4.75% if the credit rating of the borrower is 4.75 is BB to B, plus 6.25% if the credit rating of the borrower is C to D. And if there is no credit rating, then there is a limit on the loan amount. If there is no credit rating, then the loan amount, aggregate loan amount till 31st March of the relevant previous year, 31st March 2026 should be up to 100 crores. So if there is no credit rating, then the aggregate loan amount should be up to 100 crore and then it is MCLR plus 4.25%. In the first 4 cases, there is no limit of loan amount, but if there is no credit rating, then loan amount up to 100 crore is only covered in safe harbor. If it is more than 100 crore, safe harbor is not applicable. What about intra-group loan in foreign currency? In this, there are 2 slabs. If the loan is up to 250 crore, then the slabs are different, then the rates are different. If the loan is above 250 crore, then the rates are different. Here you have to take reference rate on 30th September, not MCLR. SBI's MCLR is not applicable for foreign currencies. Here you have to take reference rate on 30th September. So if the loan is up to 250 crore, you will take reference rate on 30th September plus to 1.5% if the credit rating is AAA, AA plus, AA minus, A plus, A minus. Reference rate on 30th September if the loan is up to 250 crore plus 3% BBB plus, BBB minus. 4% plus reference rate on 30th September if the loan is up to 250 crore, BB plus, BB minus, B plus, B minus, C plus, C minus, D, or no credit rating. No limit of 100 crore also over here. No limit. 100 crore limit which was there na here. In case of no rating, here there is no limit of 100 crore. Next, if the loan amount is greater than 250 crores, then there are 4 options now. Here it was 3 options. Here there are 4 options. 1.5% AAA, AA plus, AA minus, A plus, A minus. Reference rate on 30th September plus if the loan amount is more than 250 crore, the BBB plus, BBB minus. 4.5% BB plus, B minus, B plus, B minus. And 6% plus reference rate on 30th September. C plus, C minus, D, or no rating. Again, no limit of 100 crores. Okay. Next one, corporate guarantee. We are providing corporate guarantee. Sir, what do you mean by corporate guarantee, sir? Let's try to understand what do you mean by corporate guarantee. Corporate guarantee will only include explicit corporate guarantee to the wholly owned non-resident subsidiary. That's it. If it is provided to other than subsidiary, then it is not covered in safe harbor. Corporate guarantee, first of all, should be explicit corporate guarantee. And plus, it should be only to non-resident subsidiary, that to wholly owned subsidiary, not small subsidiaries. For long-term or short-term borrowing, it does not include letter of comfort. Corporate guarantee will not include letter of comfort, will not include implicit guarantee, will not include performance guarantee or similar guarantees. It should be explicit guarantee to the subsidiary, wholly owned subsidiary, which is a non-resident. I hope it is clear to all of you. They might play with these words. They have played with these words around 8 years back when safe harbor rule was applicable. I used to teach that. I know that what kind of question they used to ask. Only that places I am putting emphasis. Now, providing corporate guarantee where the amount guaranteed does not exceed 100 crores. Or if it exceeds 100 crore, then the credit rating of the borrower of the associate enterprise should be adequate to safety as per, should be adequate to of highest safety as per SEBI guidelines. As per SEBI. So, first of all, the company to whom you are giving corporate guarantee, the guarantee should not be more than 100 crore. If it is more than 100 crore, then there has to be adequate safety of that particular entity as per SEBI guidelines. Margin, just 1% of the guaranteed amount. That much minimum you have to charge. If you charge more than 1%, great. If you charge less than 1%, safe harbor not applicable. Next one, providing contract research and development software services. Now you are providing software services, software development. You are providing contract research and development. Here, your transaction value should be 300 crore and the margin OP upon OC should be at least 24%. Providing contract research and development for generic pharma drugs. What are generic pharma drugs? Generic pharma drugs are nothing but copy of the branded pharma, copy of the branded medicines. Those are generic pharma drugs which are available at cheaper price, similar composition, but lesser quality material are used in that. So you are providing contract research and development for generic pharma drugs. Again, 24% margin should be shown, and if the transaction value is up to 300 crore. So if the transaction value is up to 300 crore, your margin should be at least 24%. Okay. Next, manufacturing of core auto component. Manufacturing and export of core auto component, you have to show margin of 12%. And for non-core auto component, which are not very important in the automobile sector, that will be subject to 8.5% margin. Minimum this much has to be shown. And in these 2 cases, there is no limitation of amount. There is no limitation of amount. And last but not least, you are receiving low value adding services, intra-group service. Low value adding services means not very great service. Some very small services, which are not significant, which are not important part of the organization. Those services are called as low value adding services. So if you receive the low value adding services, your total value of the international transaction should be 10 crore and the markup in that should not be more than 5%. So the total value of the transaction should be 10 crore and the markup should be maximum 5%. So if the total value is 9.9 crore, the cost is 8 crore and the markup is 1.9 crore, this is not applicable because 8 plus 1.9 crore is more than 5%. So the cost plus markup total should be 10 crore and within that the markup should be only 5%. I hope it is clear to all of you. Further, the cost and the exclusion of the shareholder cost and the doubly cost, all this will be certified by an accountant, and they have also defined the word accountant. I am not getting into the definition of that. I have explained you that in class if you remember. Now last but not least, I have told you that if you want to follow transfer pricing safe harbor rule, then you have to maintain documents as per 92D and you have to also fill form 3CB in 92E. You will not get relaxation from these two sections. Even if you are opting for safe harbor, you have to follow this. Now how to opt for safe harbor? Very simple procedure is there. You have to fill a form 3 CEFA and give it to the AO by the due date. You can give it for a single year and you can also give it for a multiple year. You can give for 1 year or you can give for 3 years also. You have to give the statement to the assessing officer before the due date of filing of return. After that, the assessing officer may accept the application or he may not accept your application. He may feel that you are doing eligible. He will check whether you are doing eligible transaction or not, you are showing proper margin or not. If he has any doubt, he can refer the matter to TPO. Okay. He can refer the matter to TPO and then the TPO may request you to furnish some documents. After that, the TPO may declare your application to be invalid. The TPO will say that you are not eligible for safe harbor. He will give you an opportunity of being heard. If you are not happy with TPO, then you should go and appeal to commissioner within 15 days. You have a power to object to the commissioner within 50 days. Within 50 days, you can object to the commissioner. Then the matter has been to commissioner. The commissioner will check the validity and will send the copy to AO and assessee. The commissioner will check the compliance. If it is fine, then great. If it does not fine, then you have to find out the transfer pricing as per the normal provisions of the income tax law. I hope it is clear to all of you. So this is what this small procedure is all about. So you fill the form, give form 3 CEFA till the due date for 1 year or multiple years, for 3 years maximum. AO will check. AO may declare valid, invalid. AO may also help the TPO. TPO may check valid, invalid. If TPO declares invalid, then you should go to whom? You should go to commissioner. Commissioner will check valid, invalid. If commissioner check and says valid, great, go for safe harbor. Commissioner say not valid, then you should follow the transfer pricing as per normal provision. I hope it is clear to all of you. Last 1 or 2 points over here. Very important point. Rule 10F. Very important for exam. Be very careful. Safe harbor rule is not applicable in some cases if you do transaction with a person located in NJA. If a person is located in notified jurisdictional area, if you are doing transaction with that person, safe harbor rule is not applicable, or safe harbor rule is not applicable if you are doing a transaction with a person which is located in no tax or low tax jurisdiction. Now, no tax is understood that there is no tax in that country. What do you mean by low tax? Low tax means the maximum tax in the other country is less than 15%. That will be called as low tax jurisdiction. What do you mean by no tax or low tax jurisdiction? Where the maximum tax rate in the other country is less than 15%, that country will be called as low tax jurisdiction. If you are doing transaction with a person located in NJ, or if you are doing transaction with a person where the maximum tax rate is less than 15%, then safe harbor rule is not applicable. So for safe harbor rule to apply, the other country should not be NJ, notified jurisdictional area, and the other country's maximum tax rate should be minimum 15% or more. Then only safe harbor is applicable. Further, once you have gone for safe harbor rule, then your doors of mutual agreement procedure under Article 25 of DTAA will be closed. You cannot approach safe harbor rule as well as mutual agreement procedure under 90 and 90A, both of them. You cannot do both of them at the same time. That is not allowed. I hope it is clear to all of you. So this is what your safe harbor rule of transfer pricing is all about. Now we will talk about safe harbor rule of business connection 911. Now this is applicable to certain businesses. If you remember, we have done in section 911 in non-resident taxation chapter earlier that if there is a foreign company which is coming to Mumbai, Bharat Diamond Bourse, or going to Gujarat Diamond Bourse, Surat, and they are displaying their uncut and unpolished diamonds, raw diamonds, then that does not amount to business connection. Remember, if they confine their activities to display of uncut and unpolished diamonds, then that does not amount to business connection. Do you remember that? I hope you remember that. So there is a catch over here. If the foreign company is coming to Mumbai, Bharat Diamond Bourse, or Gujarat, Surat Diamond Bourse, and they are confining their activities to only display, then that is not subject to tax. What about they come to special notified zone and sell it? Then it is taxable. Now, if it is taxable, then safe harbor is applicable. So, safe harbor is applicable for sale of raw diamonds in special notified zone. So, for sale of raw diamonds, safe harbor is applicable. For this only confining to what display, safe harbor is not applicable, because in that case it is not taxable only. So, who is the assessee? Foreign company engaged in diamond mining. What is the assessee's business? Selling raw diamonds in special notified zone, Bharat Diamond Boards, Mumbai and Surat. What is raw diamonds? Raw diamonds are uncut, unpolished, unsorted diamonds, unworked, simply sewn, cleaved or bruted, non-conflict as per Kimberley process. I have explained you all this thing in class. What is Kimberley process or not? Certified by Kimberley Process Authority and classified under Tariff Heading 7102, Custom Tariff Act 1972. You have to make an application. Once you make an application, it is applicable for whom? Foreign company who is doing what? Selling raw diamonds, not displaying raw diamonds. Selling. Where? In special notified zone. Not everywhere in the entire country. So they can show their safe harbor as 4%. 4% of the gross receipt will be considered to be as their safe harbor. If they show more than 4%, we will accept. If they show more than less than 4%, we will not accept. At least 4% you have to show of your gross receipt as your profit. No PGBP deductions will be allowed. WDV of the asset will be computed in the same manner. No UAD will be allowed. No carry forward and set off of losses will be allowed. Nothing will be allowed. No business loss, no capital gains loss, nothing will be allowed to set off against your income. Nothing. But documents and Form 3CB you have to fulfill. You have to maintain all the documents as per 92D, and you also have to fill Form 3CB, that is the tax audit report, 1 month prior to the due date of filing of return by 31st of October. Procedure again same, you must submit Form 3CEFC within the due date of filing of return. Department will accept, they will not accept. If it is invalid, they will reject. Opportunity of being heard will be given, etc. Order will be given that your application is accepted or not. Here also, once you go for this safe harbor and it is accepted, then you cannot go for mutual agreement procedure under section 90 and 90A. Mutual agreement procedure under section 90 and 90A is not possible after this. I hope it is clear to all of you. Now moving on to the next section, 92D. What is 92D? 92D talks about documents and information. Which documents and information? There are 3 subsections over here. Subsection 1 says that if transfer pricing is applicable for you, international transfer pricing or domestic transfer pricing, either of the transfer pricing is applicable for you, you have to maintain a lot of documents and information, and those documents and information you have to maintain for a period of 8 years. But all these documents and information are supposed to be maintained only by those people whose aggregate value of transaction recorded in the books exceeds 1 crore rupees. If the aggregate value of the transaction in the entire year exceeds 1 crore rupees, you have to maintain all these documents and information. See, all these documents and information are applicable and are supposed to be maintained for what? If your transfer pricing is applicable for you. For applicability of transfer pricing, there is no turnover or limit. Again, understand. If your aggregate transaction value of the entire year exceeds 1 crore, you have to maintain all the documents. But for transfer pricing applicability, there is no limit. Even if 10,000 rupees international transaction is done, transfer pricing is applicable. So for applicability of documentation maintenance, limit is there of 1 crore. For how many years you are supposed to maintain? You are supposed to maintain the documents for a period of 8 years. From the end of the relevant EY. The AO or the CIT appeal may ask for the documents and information, then you have to furnish them within 10 days. You can also ask for an extension by making an application. If you give an application and if they extend you, then that is great. If they extend, then it is great. They can extend by another 30 days. Sir, what all documents you are supposed to maintain? Let's check the list of documents that you are supposed to maintain. You need to maintain profile of the multinational groups which the assessee belongs to. Ownership structure has to be known in the documents. Which company holds how much in which company. Brief description of the business and of the assessee and its associate enterprise. Nature and terms of international transaction. Financial estimates by assessee. Nature and terms of uncontrolled transaction. Analysis of comparison between international transaction and uncontrolled transaction. Computation of arm's length price. Actual working. Method. Reason for adopting the most appropriate method. Why you have adopted this method, you have to tell the reason. Official publication. From where you have taken the GP margin. Books of accounts, price publication if listed, agreement and the contract of international transaction and uncontrolled transaction. All these documentations you have to maintain. If you don't maintain all this documentation, remember in 92C, the AO has the power to determine the arm's length price. Or if you don't reply, I am interlinking. If you don't reply to the AO or CIT appeal within 10 days, in that also 92C, the AO has the power to determine the arm's length price. So this is what this provision is all about. So let's go ahead with the next part, and that is section 286, country by country reporting. Now let me give you a background of country by country reporting before we go ahead with the revision of country by country reporting. The concept of country by country reporting is inspired from OECD BEPS program. That is OECD Base Erosion and Profit Shifting Program Action Plan 13. Now what does Action Plan 13 says? Action Plan 13 says that you have to re-examine your transfer pricing documentation. Action Plan 13 recommends that you have to re-examine all your transfer pricing documentation into three parts. One into local file, another into master file, and third into country by country reporting. Local file is nothing but what we have done so far. What is local file, sir? Local file is nothing what we have done over here. That is that is just a second. There is some video which is going. Yeah, it has come back. So local file is something which you are reporting over here. This is your local file. Okay. Where if your transaction value, aggregate value of international transaction exceeds 1 crore, you have to maintain a lot of documents and information. That is your local file. One comes master file, which we will talk about in a while, and another is country by country reporting. Today we are interested in country by country reporting, CBCR. In country by country reporting, what happens? Wherever is your ultimate parent company, wherever is your ultimate parent company, like in India, there is Reliance Industry, like in India, there is Tata, like in India, there is Infosys, like in Japan, there is Sony, like in South Korea, there is Samsung, like in US, there is Apple, there is Google, there is Microsoft. So wherever is your ultimate parent company, in that country, you have to file what? You have to file CBCR. And then that country will share CBCR with another nation by entering into an automatic exchange of information agreement. For example, Sony will file CBCR in Japan, and then Sony will enter into an automatic exchange of information agreement with Indian tax authority, and Indian tax authority will get the information from Sony Japan. Similarly, Japan will get the information about Reliance Industry from Indian tax authority. So wherever is your ultimate parent entity, ultimate parent company, in that country you are going to file CBCR. So this is what this section is all about, section 286. Now we will talk about section 286 in detail as per the income tax law. I have just given you the gist of section 286 as per action plan 13. Now first thing which is there in section 286, country by country reporting, is when this reporting is mandatory. This reporting is mandatory if the consolidated group revenue of last accounting year is greater than 6,400 crore. This is which accounting year? For us, the accounting year in our examination is financial year 25-26. Financial year 25-26 is our accounting year. Therefore, you have to check the consolidated group revenue of financial year 24-25. If the financial year 24-25 group revenue is more than 6,400 crore, then CBCR is mandatory. Second, who will file CBCR? Very important question. As I have told you, if the parent is resident in India, then the parent will file. One more company is there which is known as alternate reporting entity. Now let me explain you what do you mean by alternate reporting entity. Now before knowing alternate reporting entity, you need to also know what is constituent entity. Sir, what is constituent entity? There are three types of constituent entity which are there, which are defined in section 286. First constituent entity is any entity which is a part of CFS of the company. If any entity is a part of, if any company is a part of CFS of the company, will be called as constituent entity. Second type of constituent entity, any entity which is excluded from CFS because it is very small in size, that can also be called as constituent entity. So point number one covers those entities which are part of CFS. Point number two covers those entities which are not part of CFS because the materiality and the size is very less. And point number three, if the foreign company has a permanent establishment in your country, then that permanent establishment can also be called as constituent entity. So to understand alternate reporting entity, we need to understand the term constituent entity first. So as I have told you the definition of constituent entity. Now coming back to alternate reporting entity. Sir, who is alternate reporting entity? See, by default, Sony will file CBCR where? Sony will file CBCR by default in Japan. But sometime what happens, Sony Japan designate that power, designate that particular responsibility to Sony India. Sony India is not a parent company. Sony India is a constituent entity. So if the parent has designated that particular authority and the responsibility to the subsidiary, to the constituent entity, then that constituent entity is called as alternate reporting entity. So if the parent designates the power to file CBCR in some other country, then whichever country that other subsidiary is located, that country, that entity will be called as alternate reporting entity. So there are two people to whom the responsibility has been given. First is to parent entity. When I say parent entity, you can say Reliance. If parent entity is resident in India, it means if Reliance is resident in India, they will file CBCR. Or if Reliance is not resident in India, then alternate reporting entity is resident in India, means Sony India. And who has been given the power to become alternate reporting entity? Sony Japan. I hope it is clear to all of you. Now they will file CBCR to him. They will file CBCR to joint director designated by Principal Director General of Income Tax or Director General of Income Tax, and they will file the CBCR within 12 months from the end of the said accounting year. That is for financial year 25-26. CBCR will be filed within 12 months from the end of 25-26. That is CBCR will be filed by 31st March 2027. And the CBCR has to be filed in form 3CAD. This is the form number. You may not remember the form number. It's okay. But this is the number which is there in the income tax rules. So form 3CAD is the form number. Now, third point. In the third point, you are not supposed to file any CBCR in third point. In the third point, you have to just notify to CBDT in form 3CEAC. What do you have to notify? Every constituent entity in India whose parent is outside India. Third point is relevant to those constituent entity whose parent is resident of outside India. So third point is not for Reliance Industries, not for Tata. It's for Sony India, Samsung India, Apple India, Pepsi India, Coke India. It is for those companies whose parent is outside India but the constituent is resident in India. What are they supposed to do? Every constituent entity resident in India whose parent is outside, constituent is in India. In that case, they have to notify to the joint director at least 2 months prior to the date of furnishing of CBCR. CBCR will be filed on 31st March 2027. They have to notify it by 31st of Jan 2027. What they are supposed to notify? What Sony India is supposed to notify? What Pepsi India is supposed to notify? What Coke India is supposed to notify? What Samsung India is supposed to notify? They have to notify either of the two things. Whether Sony India is an alternate reporting entity, or if Sony India is not an alternate reporting entity, then who is the alternate reporting entity? We need to know the details of that, so that we can get the CBCR from them. If Sony India is the alternate reporting entity, by 31st of March 2027, we will ask Sony India to give CBCR. If Sony India is not alternate reporting entity, if alternate reporting entity is some other country, we will take CBCR from that country. So we want the information of CBCR, who is going to file CBCR. That information we need to notify in this particular point. Now, what does CBCR actually contain? CBCR will contain the following information. CBCR will contain the information of the revenue, country-wise revenue. If Reliance Industry has 200 subsidiaries, we need to give details of all 200 subsidiaries revenue we have to give. Country by revenue, country by profit before tax, country by income tax details, capital we have to give accumulated earnings, we have to give number of employees, we have to give the details of tangible assets, other than cash and cash equivalent, we need to give the country of incorporation, where is the residential status, etc. All this information we have to give in CBCR. Now, point number 5. Point number 5, there are some issues, so which we are going to address now one by one. Let me give you one example to explain to you point number 5. What is point number 5, sir? Sony Japan, Sony India. Who will file CBCR by default? By default, CBCR will be filed by Sony Japan, because the ultimate parent entity is in Japan. So by default, the CBCR will be filed by Sony Japan. But now, suppose there are 3 issues. Issue number 1, there is no concept of CBCR in Japan. If there is no concept of CBCR in Japan, there is no similar section like 286 in Japan. Is it possible? Why not? It is possible. Second possibility, there is a concept of CBCR in Japan, but India does not have an automatic exchange of information of CBCR with Japan. So how will India get the information? Third, there is a concept of CBCR in Japan, and India also has an agreement with Japan for automatic exchange, but the Japanese government is making systemic failure in giving the information. They are not giving us information on time. We have been asking them again and again. Systemic failure, consistent failure, persistently they are failing to give the information. So in these 3 cases, what will happen? In these 3 cases, the CBDT says in this particular subsection that Sony India, that the constituent entity resident in India will file the CBCR. Sony India has to file the CBCR. In 3 cases, Sony India will file CBCR. In 3 cases, Samsung India will file CBCR. Which 3 cases? Again, I am saying, if there is no concept of CBCR in foreign country, or if there is no agreement between both the nation, or agreement is there but the other country is doing systemic failure, in these 3 cases, the constituent Indian entity resident in India will file CBCR. Now, another issue, if there are more than one constituent entity, then who will file? Who is responsible? Sony has 3 subsidiaries in India, for example. Then who will be responsible? Then the group will designate one of them. Whomsoever the group will designate, that entity will file the CBCR in India. I hope it is clear to all of you. Next one, point number 7. Again, a very important point. Let me explain you with the help of example. Let me take 3 countries. Sony Japan, Sony India, Sony Germany. By default, who will file CBCR? CBCR will be filed by Sony Japan because ultimate parent entity is in Japan. Now, suppose Sony Japan has designated Sony Germany as alternate reporting entity. Sony Japan has designated Sony Germany as an alternate reporting entity, and India as a automatic exchange of information agreement with Germany, and from Germany we are getting all the information of Sony. So Sony India will not be responsible to file the CBCR. So if the alternate reporting entity is in third nation, and with that third nation we have an automatic exchange of information agreement from where we are getting the information very easily. So in that case, Sony India will not be liable for what? Filing CBCR. And last but not least, whatever CBCR you will file to whom? You will file to joint director. So the joint director in future may call for some documents and information to verify the information, whether it is correct or not. So when the joint director call for the information, you have to give the information within 30 days. Yes, you can ask for extension of another 30 days. Assassi can ask for extension of another 30 days. If required, they will give you another 30 days extension. So 30 plus 30, maximum 60 days. If you don't give the information in 60 days, there is some penalty which is going to come under 271 GB now. A good penalty will come into 71 GB. Now we will talk about the penalties of CBCR. First penalty for non-furnishing of CBCR 271 GB. So for previous year 25-26, you have to file CBCR by 31st March 2027. So if you don't file CBCR till 31st March 2027, for first 1 month you will be liable for a penalty of 5,000 rupees per day. So for the entire April, 5,000 rupees per day, 5,000 into 30 days will be 1,50,000. After that, till you have not filed, then 15,000 rupees per day. After that, the department will send you a penalty order and will tell you to pay the penalty and will tell you to file the CBCR. Even after that, you are not paying the penalty and not filing the CBCR. Then it is directly 50,000 rupees per day. 50,000 rupees per day. So for the first 1 month, 5,000 per day. From 1st May, it is 15,000. Then the department will wait for few days, few months. After that, they will send you an order. After that also, you don't pay. You don't file the CBCR, then 50,000 rupees per day penalty will be imposed on you. Next, penalty for violating 286 subsection 6. Sir, what is 286 subsection 6? That is the last point which is mentioned over here. Point number 8. That is if that's the reason I have mentioned the subsection over here. That is, the joint director asks for the information, asks for the documents. You are not giving the information in 30 days. You may ask for an extension. You are not giving the information in extension also. Then the joint director will impose penalty of 5,000 rupees per day after the time limit is expired. What is the time limit? 30 plus 30, maximum 60 days. If extension is given, then 60. If extension is not given, then 30. So the moment time limit is expired, you will be liable for a penalty of 5,000 rupees per day. After that, you will be liable for a penalty of 15,000 rupees per day. After that, the department will send you a notice, will send you an order that this much is the penalty. Please file the CBCR and pay the penalty. You are still not replying. You still not complying with the notice and the order. Therefore, in that case, 50,000 rupees per day penalty will be imposed on you. Next penalty, 271 GB subsection 4. Sir, what is this penalty? You have filed CBCR, but you have given inaccurate information in CBCR. The CBCR is not correct. It is inaccurate. Then 5 lakh rupees penalty will be imposed in 3 circumstances. First, you knew that you had the knowledge of inaccuracy at the time of furnishing the report. When you are furnishing the report on 31st March 2027, that time you knew that the information is incorrect. Still you gave incorrect information, 5 lakh penalty. Or you discover the information later on. At the time of filing, you are not aware of that this information is incorrect. But later on, you came to know that it is incorrect and you do not rectify the mistake within 15 days. You came to know later on that the information which I gave in CBCR is incorrect. So you rectify within 15 days. If you rectify within 50 days, no penalty. Or if you don't rectify within 15 days, penalty. Third, the Joint Commissioner under 286 subsection 6, last subsection, asks for some information which you have to furnish within 30 plus 30 days. You have furnished it. If you don't furnish, then this penalty is imposed. But if you furnish and give inaccurate information, then this penalty will impose. So for non-furnishing, 5,000 and 50,000. And for wrong furnishing, it is 5 lakh rupees. I hope it is clear to all of you. Now let's talk about master file. Then what is master file? Master file contains some big information of the company, in which there are 2 parts, part A, part B. Part A, everybody has to fill. Part B, all those people have to fill who will fulfill some conditions. Again, I am saying, master file contains some big information of the company. Part A, everybody has to file. But part B will be filed by those people who are fulfilling some condition. And master file will be filed in the country in which you are resident. Whichever country you are resident. Sony India will file in India. Sony Japan will file in Japan. Reliance Industry will file in India. Apple will file in US. Whichever country you are resident, you will file. If subsidiary is resident in India, then subsidiary will file. The parent is resident, and parent will file. Now, part A is, again I am saying, part A contains some basic information like name, PAN number, etc. So part A is applicable for everyone. Part B is applicable to those people who fulfill some conditions. So for part B, which conditions we have to fulfill? There are two conditions we have to fulfill. The consolidated group revenue of the current year now, not last year. In CBCR, we have to check the last year revenue. But in master file, you have to check the current year revenue. The consolidated group revenue of the current year should exceed 500 crore, and at the same time, one more condition has to be fulfilled. And the aggregate value of international transaction during the accounting year exceeds 50 crore. Or individual international transaction like purchase, sale, lease, transfer, etc. should exceed 10 crore. Either aggregate international transaction should exceed 50 crore or individual transaction should exceed 10 crore. Along with that, the turnover should exceed 500 crore. Turnover condition has to be fulfilled. There is no excuse in that. So the turnover, global turnover in the current year should exceed 500 crore, and the aggregate value of international transaction should either exceed 50 crore or the individual value of international transaction should exceed 10 crore. Then you have to file part B of master file. Part A is to be filed everybody. Part A everybody has to file. I hope it is clear to all of you. Now let's go to the next section, 92E, which is very important. Very important academically for us and also practically. 92E, report from chartered accountant. What does 92E say, sir? You have to take a report from a CA. You have to take a report from a CA. Every person entering into an international transaction or specified domestic transaction has to take a report from a chartered accountant in Form 3 CEB and file the report by 31st of October. And if you fail to file this report, of Form 3 CEB, then there is a penalty of 1 lakh rupees under 271 BA. If you don't file this report, there is a penalty of 1 lakh rupees under 271 BA. This is the first penalty. Now, multiple penalties will come one by one. Second penalty, you have filed the report, but you failed to report the transaction. So, what is Form 3 CB? Form 3 CB contains the list of all international transactions and specified domestic transactions, through which the assessing officer comes to know that these are the international transaction and the domestic transaction which the assessee has done on which transfer pricing is applicable. So, it's a list of all the documents. It's a list of all the transactions. So, if you fail to give that particular list, then if you fail to give that report, then there is a penalty of 1 lakh rupees. But, sir, I have filed the report, but I failed to give some transaction in that. Suppose there is a report in which there are 10 transactions which are supposed to be reported, but I reported only 8 transactions. 2 transactions I failed to report. Then there is a penalty of 2% of the value of transaction under 271AA. 271AA, there is a penalty of 2% of the value of transaction. Okay. Sir, I have done 10 international transactions and I failed to file the report only. Then what is the penalty? Then both the penalties will be imposed. So if you have done 10 international transactions and if you have done 10 international transactions, if you fail to give the entire report only, then you have done 2 mistakes. First mistake, you have not filed the report, therefore 1 lakh penalty. And if you have not filed the report, that automatically means that you have not reported the transaction. See, not filing the report means absolute absence of all the reporting of the transactions. Then in that case, all 10 transactions are unreported. So on all 10 transactions, 271AA will be imposed on you. Be careful with it. So I have made a master chart of the penalties over here with respect to transfer pricing. One by one, I am explaining you now. Some of them we have done. Some of them we will do now. First of all, right hand side, 271BA. 1 lakh rupees if you don't submit Form 3 CEB. 271AA, 2% of the value of transaction. Now 271AA can be imposed because of 3 reasons. One reason I have already told. First reason is if you fail to report transaction in Form 3 CEB, and 271AA will be imposed. This I have already told you here. Now there are 2 more reasons because of which 271AA can be imposed. Second is fail to keep and maintain documents. Fail to keep and maintain documents as per what? As per 92D. In 92D, you have to maintain a lot of documents and information. If you fail to maintain and keep the documents for 8 years from the end of relevant EY, a penalty of 2% of value of transaction can be imposed. Third one, you are not failing to maintain. You are maintaining, but you are maintaining incorrect documents, incorrect information. Then also penalty of 2% of the value of transaction. So, if you don't report the transaction, then 2%. If you fail to maintain documents, or if you maintain documents but you maintain incorrect, then in all 3 cases, you will be liable for a penalty of 2% of the value of transaction. Now, second point. 271G also, there is a penalty of 2% of the value of transaction. So, what is 271G? 271G talks about if you fail to comply with 92D subsection 3. Sir, what is 92D subsection 3? 92D subsection 3 talks about AO or CIT appeal may ask for some information from you. Some documents from you have to give within 10 days. If you don't give within 10 days, then you may ask for extension of another 30 days. Maximum 40 days time limit is there. And if you don't give in 40 days also, then there is a penalty of 2% of the value of transaction. And all these penalties are over and above each other. A person can be imposed with 271AA also, 271G also, 271BA also. Along with that, if you don't report this point number 1, check, very dangerous this is. If you fail to report transaction in Form 3 CB, that is also called as misreporting under income tax law as per 270A 9. Therefore, it can also lead to 200% of the tax payable as penalty. So failure to report transaction can also lead to what? 200% of the tax payable as penalty under misreporting of penalty, misreporting of income. But with this penalty, you can get escaped if you fulfill the following conditions. If the ALP is determined by TPO, but you have maintained all the documents and information as per 92D and you have disclosed all material facts relating to transaction. So if the ALP is determined by TPO, he has increased the income, but you have maintained all the documents, you have reported everything properly, you have maintained all the documents, you have given all the information and truly and fully, then in that case, this penalty will not be imposed. I hope it is clear to all of you. Otherwise, there can be 200% of the tax payable as what? As misreporting of income penalty also on you. I hope it is clear to all of you. This is very dangerous. Now let's go ahead with the next part. Some detail and big concepts will now come one by one, which are very important for the examination. The very first concept over here is advanced pricing agreement. Sir, what is advanced pricing agreement? The provision of advanced pricing agreements are given under 92CC and 92CD, and along with that, we also have to see the rollback provisions. Rollback agreement. Sir, what is 92CC and 92CD? One by one I am saying. I am telling you each and everything with the proper examples. Sir, what is advanced pricing agreement? Advanced pricing agreement is an agreement where I enter into an agreement with CBDT with an approval of central government, where CBDT will determine my arm's length price, which will give me certainty. Once CBDT will determine my arm's length price, nobody will raise question. AO cannot raise question, TPO cannot raise question, CIT cannot raise question. AO cannot determine arm's length price then under 92C. TPO cannot determine arm's length price under 92CA. CIT cannot revise my order in future. AO cannot reopen my 147 in future. Even I cannot appeal. So I have to make an application to CBDT with prescribed fees. Payment is there. Let us see all of them one by one now. So I will make an application to CBDT and say that, sir, CBDT, I am doing this transaction and please tell me the arm's length price. CBDT will either tell you the arm's length price or they will tell you the manner. They will tell you either of the two things. They will directly tell you the arm's length price, that this much is the arm's length price, 100 crore. Or they will tell you the manner in which the arm's length price has to be computed. Either of the two things they will say. This agreement will be valid for maximum 5 consecutive PYs. This agreement will be valid for maximum how many years? For 5 consecutive PYs. And this agreement is not applicable for domestic transaction. It is only applicable for international transaction. Once this transaction is entered, once this agreement is entered, after that again I have told you no AO, no TPO, no CIT appeal, no CIT, nobody will raise any question. Even you cannot appeal. You can appeal other matters, but you cannot appeal those matters which are covered in advanced pricing agreement. So let's take an example. Suppose Hindustan Lever makes an application to CBDT on 10th July 2022 for determining arm's length price from 22 to 26. Such agreement must be approved by central government. It cannot be entered for more than 5 consecutive PYs. The fees is as follows. If the transaction value is up to 100 crore, you have to pay a hefty fee of 10 lakh rupees. If the transaction value is more than 100 crore, but up to 200 crore, you have to pay a hefty fee of 15 lakh rupees. And the transaction value is more than 200 crore, you have to pay a hefty fee of 20 lakh rupees. Can I withdraw the application? You can withdraw the application after making an application, but the fees is not refundable. You will not get the refund of the fees. Further, as I have told you, specified domestic transactions are not covered in this agreement. Now, once the agreement will be signed, suppose the agreement is signed on 1st September 2023 for 5 consecutive PYs. Then the agreement will tell you either the manner or the agreement will tell you the amount. This will overrule 92C. Therefore, AO will not come into picture. Now, AO cannot interfere in between. This will overrule 92CA. TPO cannot interfere in between for 5 years. It is binding on you also. You also cannot change the arm's length price for 5 years. Even CIT will not open 263. Even AO will not open 147 later on. Don't worry. Nobody will raise any question. Now, let's take some important dates now. Entire discussion is on dates now. Just try to understand that you made an application on 10th of July 2022 for these 5 years. And on 1st September 2023, CBDT has already signed the agreement. Now, let me ask you one question. Check the dates. On this date, have you already filed the return for 31st March 2022? The answer is yes. 31st March 2022 is also covered in agreement. But you have already filed the return as per APA or not as per APA? Not as per APA, because you have filed the return of this on 30th of November 2022. So when you filed the return of this on 30th November 2022, at that time the agreement was not signed. So you have filed the return as per what? Not as per APA. So now what should I do? Now APA is signed. So the issue is, when APA is signed, at that time one of the year covered in APA is already completed, for which the return is already filed. What should I do? You are supposed to just do one thing. You are supposed to file the modified return within 3 months from the end of the month in which the APA is signed. APA is signed when? APA is signed on 1st September 2023. So you have to file modified return within 3 months from the end of September 23. So you have to file modified return by 31st December 2023. In that case, the AO will do assessment as per this particular modified return only, don't worry. But when you file the modified return, you have to only change that much items which are covered in APA. You cannot claim deductions of new items. You cannot claim deductions of new items in modified return. You will only change modified return to the extent to give the effect of APA. Nothing else will be covered in that particular APA. I hope it is clear to all of you. Second possibility, for this year, suppose for this year, what the law says, 31st March 22, you have already filed return on 30th November 2022, and APA is signed on 1st September 2023. So suppose for this year, you have the time to file modified return till 31st December 23. But suppose before that date only, the AO has completed the assessment on 30th November 2023. Till which date you had the time? You had the time till 31st December 2023. But the AO has completed the assessment 1 month before that only on 30th November 2023. Don't worry. Even if the AO has completed the assessment, you do your job properly. You file modified return by 31st December 2023. It is duty bound on the assessing officer to modify the assessment order. So the assessment order which is passed on 30th November 23, the AO will rectify that order, will modify that order and will give you the order as per the APA. And after that, to modify this, the AO has been given 1 year extra from the end of the financial year. Because he has already completed his assessment. So now the AO should be given extra time. So AO will be given extra 1 year from the end of the financial year in which the modified return is filed. Suppose third possibility. For 31st March 2022, third possibility is what? You have to just do one thing. By 31st December 23, you have to file modified return. Suppose on 31st December 2023, my assessment is still pending. Still, you do one thing, you do your job properly. You file modified return by 31st December 23, the AO will do assessment as per the modified return only. He will not do the assessment as per the original return. He will do assessment as per the modified return. And here also the AO will get extra 1 year to complete the assessment. Now, whatever advance pricing agreement it is written, is it binding on everyone? Yes, it is binding. It is binding on AO, it is binding on assessee, it is binding on TPO, it is binding on CIT. But in two cases, it is not binding. If in future there is a change in law or there is a change in facts of the agreement, then it is not binding on the department. So in two cases, it is not binding. If there is a change in law or if there is a change in fact. In one case, the advance pricing agreement will be void ab initio. If later on the department comes to know, CBDT comes to know that you have obtained advance pricing agreement by fraud or misrepresentation of fact, then it will be void ab initio. The entire agreement will stand cancelled. So in future, if the department comes to know that you have given wrong information to get the valuation done, to get the arm's length price done, you have given incorrect information to CBDT so that the arm's length price should come lower. So if they come to know that, the entire agreement will get violated, will get cancelled, will be considered as void ab initio, and whatever time is lost of CBDT, that much time extra will be given to all the officers under the income tax law to do their proceedings. For example, when was the agreement signed? Agreement was signed on 1st of September 2023. And let's say CBDT came to know on 31st of August that it has been obtained by fraud or misrepresentation of fact. So from 1st September 23 to 31st August 24, it is exactly 1 year. So all the officers will get exactly 1 year extra time to issue notices, to complete assessment. All the powers under the income tax law will be given extra 1 year. I hope it is clear to all of you. Now we will talk about rollback provision. First of all, you need to be very clear with some terminology. Which terminology, sir? What is rollback and what is APA? Always remember, APA is for future and rollback is for past. Suppose I entered into an APA. So, for future I don't have to worry, but for past I have to still worry. The AO will not raise question for the next 5 years. But what about the past 4 years? The AO will raise question for the last 4 years, last 5 years, last 10 years. So now I want certainty for the earlier years also. I want certainty for past years also. So I am telling the AO to roll back my APA for the last 4 years also. So now you can maximum get certainty for 9 years. 5 years future, 4 years before. Now to roll back, you have to fulfill certain conditions. So always remember, when I say advance pricing agreement, it is for future. And when I say rollback agreement, it is for past. Don't say advance pricing agreement for past. The word past and advance cannot go hand in hand. For past, you say rollback. For future, you say advance pricing agreement. So now you have to fulfill some conditions if you want to roll back your APA to the last 4 years. You can roll back to maximum 4 years, not more than 4 years. For that, you have to pay separate fees of 5 lakh rupees. So what are the conditions? Condition number 1, the international transaction is same. Same means the international transaction of APA of future 5 years and the international transaction of past 4 years should be same. Sir, what do you mean by same? The word same has been defined by CBDT in circular number 10/2015. What does the word same means? Same means it should be of same nature. It should be with same associate entity. Same means it should be of same nature with same associate entity, and the FAR analysis should not materially change. Minor change is okay. Materially it should not change. So royalty, XYZ, XYZ. Along with that, the FAR analysis, functions, assets and risk of the company, minor change is okay. Major change should not be there in the functions of the company, in the assets employed of the company, in the risk taken of the company. Then it can be called as same. I hope it is clear. Second condition. The return of the rollback year has been furnished under 139(1). So for the rollback year, the return should be filed on time. Sir, what if I file the rollback return in under 139(4)? Then you cannot roll back. Sir, what if I file the return of the rollback year under 139(5)? If you have filed the return under 139(5), but the original return was filed under 139(1), then you file revised return under 139(5), then you can roll back. But if you have filed the original return under 139(4) and now you are filing revised return under 139(5), then you cannot roll back. This is what it is mentioned in point number B over here. Check it please. One by one, I am clarifying the circular also. So if the original return was of the rollback year was filed on time under 139(1) and then it is revised under 139(5), you can roll back. But if the original return is filed under 139(4), you cannot roll back. Third condition. For the rollback year, you have filed for report under Form 3 CEB under 92E. So for all the 4 rollback years, you should file the report under Form 3 CEB under Section 92E. Point number D, very important point. If you want to roll back, you have to roll back for all the years for which international transaction has been undertaken. So if you want to come for all 4 years or else don't come. Sir, what do you mean by this? Sir, in one of the year, I have not entered into a transaction only then. The transaction is royalty. In one of the 4 years, in only 3 years, we have entered into a transaction of royalty with same associate entity. In 1 year, we have not entered. Then can I go for rollback of the remaining 3 years? Yes, in that case, you can go for rollback for the remaining 3 years. One more case, one more relaxation is given by CBDT over here in point number A. That is, in one of the year, you have violated some condition. Out of the 4 rollback years, in one of the year, you have filed the return late. Or in one of the year, you have not filed the Form 3 CB on time. So you can go for rollback for the remaining years. So if in one of the year, rollback is, if in one of the year, international transaction was not same, or in one of the year you have violated some condition, you can go for rollback of the remaining years. I hope it is clear to all of you. Last but not least, you have to make a Form 3CD application along with a fees of 5 lakh rupees. I hope it is clear to all of you. Now, in some cases, rollback is not possible ever. When it is not possible? If your determination of arm's length price of the rollback year has already been subject matter of ITAT and ITAT has passed an order disposing of such appeal. So if the last 4 years matter is already, if any of the years matter is already in ITAT and ITAT has closed the matter, passed the order, disposed of the matter, confirmed, annulled or modified, that's it, closed. So if the ITAT has already closed the matter, what will the CBDT do after that? CBDT will say the same thing only. So rollback is not possible after that. Sir, what if the matter is already pending in ITAT? If the matter is pending in ITAT, then you can go for rollback. If the matter is closed in ITAT, then you cannot go for rollback. I hope it is clear to all of you. Similarly, rollback is not possible if it has the effect of reducing the income or increasing the loss. If after doing the rollback, the income is reducing, it means it is giving loss to the CBDT and benefit to the assessee. Or if the loss is increasing, it means benefit to the assessee. Then in that case, rollback is not possible. Rollback is possible only if the income increases or if the loss decreases. Otherwise, rollback is not possible. I hope it is clear to all of you. But in this case also, there is one issue. Your income should not reduce as compared to your ROI. What do you mean by this? It means suppose in the ROI. In the ROI, I have shown 100 lakhs as income. Now the TPO has increased the income to 120 lakhs. Now because of the rollback agreement, it has becoming to 90 lakhs. So it is not possible. Rollback is not possible because your rollback is lesser than what? Rollback income is lesser than your ROI income. But in this case, if I agree that, if I tell the CBDT that I agree to declare my income as 100 lakhs, even though the rollback says 90 lakhs, I don't want to show 90 lakhs. I agree to show 100 lakhs as an income. So can I go for that? Then in that case, you can go for rollback. Your income should not go below what is declared in ROI. It is nowhere written that your income should not go below what is declared by TPO. No. Your income should not go below what is declared in ROI. I hope it is clear to all of you. So if whatever is declared in ROI, if you agree to show that much income in the return, then you are allowed to go for rollback. I hope it is clear to all of you. Now, next point. Can I only go for rollback? Only rollback is not possible. No. Can I only go for APA? Yes, only APA is possible. Only rollback is not possible. Without APA, rollback is impossible. Only APA is possible. If you want to go for only future transactions agreement, you can go for that. But if you want to go for only past transactions agreement, that is not practically possible. That is not possible. I hope it is clear to all of you. Last but not least, in case of merger and demerger, what will happen, sir? Very important. Try to understand this example. There is A limited, there is B limited, there is C limited. Now A limited is acquiring B and C, and A limited is A limited only. The A limited entity is not changing. So A limited is acquiring B limited and C limited. B limited, C limited dissolved. A limited is A limited. B and C are now part of A limited. Now in that case, A limited is making application for APA. Can A limited go for rollback? Yes, A limited can go for rollback because A limited is an applicant. Whomsoever is the applicant can go for rollback. You have to check the PAN number. In this case, if A limited is making application, A limited can go for rollback. B and C cannot go for rollback because B and C are not applicant. B and C are part of A now. They are not applicant. They are not the one who has made application for APA. Take another example. A limited, B limited, C limited. All three have merged together and made a new company, D limited, fourth company. Now D limited is making application for APA. Now neither A can go, B can go, C can go. Nobody can go for rollback because the applicant is altogether different. A, B and C are not making application for APA. It is D, which is a new entity, which is making an application for APA. This is what it is mentioned in point number F and point number G. I hope it is clear to all of you. Now let's move on to the next point. That is limitation of interest. Very important section. One of the most important section of transfer pricing is this. So many questions are there in ICI, RTPs, MTPs, exam paper, and even in MCQs. And some or the other place they definitely test this provision. So what is limitation of interest? Here the CBDT is limiting your interest to a particular percentage. Which interest, sir? Arm's length interest. See, suppose you are paying interest of 150 crore to your associate entity. But the arm's length interest is only 100 crore. So 100 crore will be allowed as per transfer pricing. So again I am saying you are paying 150 crore to your associate entity, but arm's length price is only 100 crore. Therefore only 100 crore will be allowed as per what? As per transfer pricing. 50 crore will be disallowed. Now this 100 crore which is allowed as per transfer pricing now, that will also be limited under this section. So for limitation of interest, first you have to find out the interest allowed as per transfer pricing. After that you have to limit that. You don't try to limit 150 crores because out of 150 crore, 50 crore is already disallowed under transfer pricing laws. So we are not disallowing something which is already disallowed because that will be leading to double disallowance. So first disallow the transfer pricing effect. After that, whatever is the allowed interest, that we are going to limit under 94B. I hope it is clear to all of you. So for that purpose, who is the borrower? The borrower can be two people, Indian company or a permanent establishment of a foreign company. Only companies are covered, none other person other than company is covered. The borrower can be Indian company or a permanent establishment of foreign company. No other person can be called as borrower. What borrower has to do? Borrower has to take money from three people. First, borrower will take money from associate entity, obviously who is non-resident. Borrower will take money, loan from associate entity who is non-resident, and borrower will incur interest on it. This is known as normal debt. Now there are two deemed debt also. Very important. They will test you with this in the examination. So from three people you will raise money. First is from your associate entity will raise money and you will pay interest. That will be subject to limitation of interest. Second, you are taking money from third party, not from your associate entity. You are taking money from third party and your associate entity is giving guarantee to them. That is also covered in limitation of interest. Third, you are taking money from third party and your associate entity has deposited matching amount to that particular third party. For example, you are taking a loan of 5 crore from your third party and your associate entity has given a deposit of 5 crore to your associate entity, then that is also covered in deemed debt. Now in this point number 2, there are some issues which I would like to address one by one, which ICI has taken a view. Suppose the associate entity has given 10 crore, but associate entity has given 10 crore to third party and third party has given only 5 crore to you. Now here ICI has taken two views. Sometimes ICI says that it is not matching, therefore limitation of intersection will not apply because 10 crore and 5 crore are not matching. Sometimes ICI says no, it is partially matching. Given 10 crore, taken 5 crore, 5 crore is matching. So you should apply transfer pricing provision 94B on this also. Second opinion is more correct. The reason otherwise everybody will give marginally less or more so that it should not match. Third associate entity is giving 5 crore to a third party, then third party will give you 5 crore and 1 rupee and then they will say it is not matching. That will easily evade the provision. Therefore second provision is correct. Second assumption is more correct. Third associate entity is giving 5 crore and they are giving you 2.5 crore, still transfer pricing provision shall apply on 2.5 crore. Still 94B provision should apply on 2.5 crore. I hope it is clear to all of you. In one case, it is not applicable. If the lender is a Citibank India, if the lender is Citibank India, then provision will not apply. Sir, why are you using the word Citibank India? Because the word used over here is if the lender is a P of a non-resident, which is a banking business in India. That's the reason I am saying Citibank India. If the lender is a Citibank India, then the provision of this section shall not apply. If the lender is a, say for example, Barclays India, if the lender is say Bank of America India, Bank of Germany India, Standard Chartered India, HSBC India, then this provision shall not apply. Because it is written, if the lender is a permanent establishment of a non-resident who is doing banking business in India, then this provision shall not apply. I hope it is clear. Now, next, what should be the amount of interest? The amount of interest which is allowed under PGBP should exceed 1 crore. This 1 crore should be after applying the transfer pricing provisions. After applying the transfer, this is the allowed interest. After applying the transfer pricing provision, if the amount of interest exceeds 1 crore, this section is applicable. Now, this section is not applicable to few people. If the borrower is banking company, then this section is not applicable. If the borrower is insurance company, this section is not applicable. If the borrower is NBFC, which is notified by central government, this section is not applicable. If the borrower is a finance company located in IFSC, then this section is not applicable. Now, for finance company located in IFSC, there is a detailed discussion which is given over here. Who can be called as a finance company located in IFSC? It will be finance company as per the IFSC Authority Act, who deal in one or more permissible activity, and they do not accept public deposits from resident and non-resident. They do not take money from public. They take money from institutional investors, big investors, not from public. And they are not registered as a banking unit. So finance company is a company which is as per the IFSC Act. They deal in one or more permissible activity. Which are those permissible activity that I will see now? They do not accept public deposit, they from resident and non-resident, and they are not registered as a banking unit. What is the permissible activity they enter into? They enter into the normal permissible activity like lending in the form of loan, commitment, guarantee, credit enhancement, securitization, finance lease, factoring and forfeiting of receivables, function of global and regional corporate treasury centers such as borrowing, lending, hedging of currency, commodity risk, investment, cash management, structured credit, intra-group financing, financing budget, and similar other activities. These are the points which are covered in one or more permissible activity. If they are engaged in any of the permissible activity, they will be called as what? As a finance company. And if they are a finance company, the provisions of 94B are not applicable on them. Now, the most important point, how much interest will be disallowed? It all depends upon your interest and EBITDA. First of all, you have to compute your 30% of EBITDA earning before interest, tax, depreciation and amortization, and whatever is excess of 30% of EBITDA, that will be point number 1. EBITDA is how much? EBITDA is 100 crore. And your interest is how much? Interest is 70 crore. So 30% of 100 crore is 30 crore. So how much is excess? Excess is 40 crore. That will come in point number 1. Now the issue is in point number 1, when we compare the 30% of interest, 30% of EBITDA with interest, which interest shall we take? Shall we take total interest or only interest paid to associate enterprise? So here there are two views. In point number 1, you can take both the views. ICI has taken both the views. They have said that you can take the total interest and then compare with 30% of EBITDA. Total means interest paid to everybody. Or you can only compare your 30% of EBITDA with the interest paid or payable to your associate entity. I hope it is clear to all of you. In point number 1, both the views are correct. In point number 2 is very straightforward. There are no two views possible here. In point number 2, you have to take the interest paid to associate entity. Which interest? Interest which is allowed after transfer pricing, allowed after TP. First give the TP effect and then check the interest amount. Otherwise, double disallowance will happen. I hope it is clear to all of you. So in point number 1, you have to take total interest or interest paid to associate entity. Compare that with 30% of EBITDA. Whatever is the excess, point number 1. Point number 2, always interest paid to associate entity. I hope it is clear to all of you. Now, whatever interest is disallowed, don't worry, don't be disheartened. Whatever interest is disallowed, you are allowed to carry forward in the next year. You are allowed to carry forward in the next year, and you can carry forward and set off for 8 years against your other PGBP incomes, against any PGBP income. So whatever interest is disallowed under 94B can be carried forward and set off against any PGBP income. Any PGBP income you can carry forward and set off. We can set off against any PGBP income. Yes, any PGBP income you can set off, but subject to the limits mentioned in 94B. So how to determine the limits mentioned in 94B? You have to take within the limits of 94B next year. Suppose next year the EBITDA is 100 crore. So up to 30% will be allowed to you. Therefore, next year total 30 crore interest you can claim. Now suppose next year interest is 20 crore. So next year 20 crore will be allowed and last year's 10 crore will also you can accumulate. Total 30 crore you can claim in the next year. This is how you will compute in the next year. So in the next year, whatever is the total EBITDA, take 30% of that, and next year interest plus last year's carry forward interest, total will be up to 30 crore will be allowed to you. I hope it is clear to all of you. So this is what this beautiful provision is all about. Now let's go ahead to the next one, which is again a very, very, very important provision for CA final student. This one and the previous one, 94B or 92C, one of them in most of the cases is always asked in examination. That is secondary adjustment. Sir, what is secondary adjustment? For that, you need to understand what is primary adjustment. Primary adjustment is nothing but the normal adjustment done in transfer pricing. I made a payment of 150 crore to my associate entity as royalty, but the arm's length price is 100 crore. So that 50 crore which we are adding now, 50 crore we have to add now. That will be called as primary adjustment. That 50 crore is primary adjustment. Primary adjustment can be done by SRC, it can be done by department also, it can be done by many other reasons, which we will see one by one now. Primary adjustment is nothing but the transfer pricing adjustment. That is your primary adjustment. Now what is secondary adjustment? Now whatever extra you have given, how much you have given? 150 crore you have given to your associate entity. How much you are supposed to give as per transfer pricing law? Only 100 crore. Whatever extra you have given, that is considered as deemed loan. On that interest will be charged if you don't bring back that money to India within a specified time, within a prescribed time. So if you bring back the money in India within prescribed time, you will be escaped, or else you will be liable for secondary adjustment. On that interest will be charged. So first of all, we need to understand what is primary adjustment and who can do primary adjustment. Primary adjustment is your normal transfer pricing adjustment, which can be done by assessee suo motu while filing the return on 30th November, or it can be done by AO or appellate authority. And if it is accepted by assessee, then transfer pricing is applicable. If it is not accepted by assessee and if the assessee appeal the primary adjustment, then secondary adjustment is not applicable. For secondary adjustment to apply, whatever the AO will add back, you have to accept first. If you don't accept, you file an appeal to CIT appeal or JC appeal, then secondary adjustment is not applicable. So if you challenge the primary adjustment, then secondary adjustment is not possible. If you accept the primary adjustment, then secondary adjustment is possible. Third, primary adjustment can also happen because of advance pricing agreement. Primary adjustment can also happen because of safe harbor rule. It can also happen because of DDAA. There are multiple reasons because of which primary adjustment can apply, but first and the second is more important academically. Further, primary adjustment should exceed 1 crore rupees. Only then the secondary adjustment is applicable. If the primary adjustment is up to 1 crore, then the concept of secondary adjustment is not applicable. So this is only applicable for big cases, not for small cases. So if your primary adjustment is only 50 lakh, 30 lakh, 20 lakh, then secondary adjustment concept is not applicable. Further, a transition provision was brought in 2017. That if the primary adjustment is done before 16, 17 or earlier, then secondary adjustment is not applicable. So now this second point is not relevant for us. For us, what is relevant is point number 1. So again, to understand secondary adjustment, you need to understand primary adjustment. What is primary adjustment? It is nothing but the difference between your actual price and arm's length price. Actual royalty paid is 150 crore. Arm's length royalty is only 100. So you are paying extra 50 crore. Add back. That extra 50 crore will be called as deemed loan if you don't bring back the money within specified time. So within how much time you have to bring back that money? You have to bring back that money within 90 days from the due date of filing of return in case of point number 1, point number 3, point number 4, point number 5, and in case of point number 2 where AO or appellate authority is increasing the income, then you have to bring back the money within 90 days from the date of order by the authority. So if you are suo motu doing the addition, if you are suo motu making primary adjustment, you have to bring back the money within 90 days from the due date of filing of return, and if the appellate authority is doing, then you have to bring back the money within 90 days from the date of order. Sir, who will bring back the money? You can bring back the money within 90 days. You can bring back the money through any non-resident associate entity. It is not necessary that you should bring back the money from the same entity. Suppose you have given excess money to XINC and there is another non-resident associate entity which is YINC. Even YINC can repatriate the money to India within 90 days. That's okay. It is not necessary that only XINC should give. Any non-resident associate entity, if they send money back to India, we will escape you. Otherwise, we will charge interest. We will take tax. So let's assume the money has not come to India within 90 days. Then what will happen? Then you have to charge interest. So for charging interest, we need to know the rate of interest. We need to know the period, etc. Yes. So for that, we need to check the transaction was denominated in which currency. If the transaction is denominated in INR, then the rate is different. If the transaction is denominated in foreign currency, then the rate is different. Let's talk about if it is denominated in INR. Then you have to take 1 year marginal cost of lending rate of SBI on the first day of the relevant PY plus 3.25%. Okay, sir. What is relevant PY? Relevant PY means the PY in which the interest is charged. In whichever year you are computing the interest. For whichever year you are computing the interest, that year's 1st April you have to take MCLR plus 3.25%. Okay, understood, sir. Sir, what if the currency is denominated in transaction is denominated in foreign currency? If the transaction is denominated in 50 crore dollars, so first convert that 50 crore dollars into rupees and then go ahead. So how to convert that? For conversion, you have to take TTBR on the last day of the financial year in which the international transaction was undertaken. So in whichever year international transaction was undertaken, in our example, international transaction is undertaken in previous year 2025-26. So you have to take TTBR on 31st March 2026, convert that into rupees first. And then you have to apply 6 months LIBOR on 30th September of the relevant PY. What is relevant PY? Relevant PY is the PY in which the interest is charged. For whichever year the interest is charged, for that year, 6 months LIBOR you have to take plus 3% you have to take. LIBOR plus 3%. I hope it is clear to all of you. Sir, by counting the period, you have to count the period from where? You have to count the period including the 90 days period. Let me give you an example. For previous year 25-26, you will file the return on 30th November 2026? Yes. Now you have 90 days from 30th November 2026. Which will expire on 27th of February 2027. So if you don't bring that money back to India by 27th of February 2027, you have to include the 90 days period also. You have to compute interest from 30th November, not from 20th February, not from 27th February. You have to include the 90 days period and count the interest. I hope it is clear to all of you. Sir, is there any way we can get escape from this? Till when this interest will be charged? This interest will be charged till the time you don't bring back the money to India. Sir, if we don't bring back the money to India for 5 years, then interest will be charged for 5 years. Yes? Why not? Bring back the money to India. Sir, is there any other way that where we can escape from this interest? There is only one way. You pay one-time additional tax. How much tax, sir? 18% tax, 12% surcharge, 4% cess, 20.9664 one-time additional tax you pay. Once you pay this one-time additional tax, after that interest will be not charged. Till that date, interest will be charged 100%. Nobody is going to leave you. One-time additional tax you pay and you will be escaped. Once you pay the additional tax, after that interest will not be charged. And whatever additional tax you have paid, that will not be allowed as a deduction under any provisions of the income tax law. You cannot claim that as an expense. Further, whatever additional tax you have paid, you cannot claim the credit of that like TDS, TCS or advance tax. You cannot claim the credit also of that. I hope it is clear to all of you. Is it clear? I hope it is clear. So this is what this beautiful provision is all about. Okay. Now let's go ahead with the next point, that is the provision of MAT along with 92CC Advanced Pricing Agreement and 92CE. That is secondary adjustment. Now to understand this particular provision, let's take some example. Suppose this is past year. Past year means last year. Let me give you one example, otherwise you will not understand this particular provision properly. This is past year. Past year means, say, let's take 24-25. In this year, your book profit was, say, 90 lakhs. Okay. And current year means 25-26. In this year, your book profit is, say, 95 lakhs. Now, in this year, you have made an application for APA. You have made an application for APA and the APA got signed here. When the APA got signed, your income got increased in the accounts by 35 lakhs. So now your income is coming to 130 lakhs. Okay. But this income pertains to which year? This income pertains to this past year. So now because of which, what is happening in the current year, your book profit is increasing and your tax is increasing. So therefore the CBDT is giving you relaxation in the current year from your current year tax. So how will you compute your current year tax? On 130 lakhs, you will compute your tax as per book profit, 15% tax, 7% surcharge and 4% cess. From that, the CBDT is giving you this much relief. A minus B minus D minus C. What is A? What is B? What is C? What is D? Let's try to substitute. What is A? A is tax payable by company under 115 JB on book profit of the previous year, that is of the current year, including past income. So now you have to compute book profit of the previous year, including past year income. So first you will compute tax on 30 lakhs. Then what is B? B is the tax payable by company on book profit of the previous year after reducing the past income. So now you will not take the past year income. So you will now compute book profit tax on 95 lakhs. Okay. So this will give you A minus B. Similarly, what is D minus C? D is again tax payable company of the book profit of the past year now. Now you have to compute book profit of the past year, that is this year's tax. Now you have to increase the past year income. So now you have to take tax on 90 plus 35. 90 plus 35 comes to how much? 125 lakhs. So now you will compute tax on 125 lakhs. In this point number 3, sorry, not point number 4. Sorry, tax on 125 lakhs. And then on C, you will compute again tax on how much? Tax on only 90 lakhs. So it is very simple. How much relief the government is giving you? Let me tell you. In A, let me tell you again once again. In A, you will compute tax of current year including past income. In B, you will only take tax of current year excluding past income. In D, you will take tax of earlier year including past income. In C, you will take tax of earlier year excluding past income, and then whatever is the amount which the difference is coming, that will be given as a relief to you. Not very important provision for the examination. You will not get any example of this in any of the book. Any of the book you will not get any example, including ICI material. This is the example which I have created from my side. Now coming to some theory part over here, which are also very important. I am not saying it is not important. This is very important. Then NJ provision will come. That is also very important. In between, some domestic transaction provision will come. That is not much important for examination. Now coming to dispute resolution panel 144C. What is a dispute resolution panel, sir? First of all, don't get confused between dispute resolution panel and dispute resolution committee. Dispute resolution committee is to address issues with respect to penalties and prosecution where they give you some immunity. But dispute resolution panel is mainly for transfer pricing issues and for non-residents. Dispute resolution panel, let's talk today about that. Dispute resolution panel is a committee, it's a collegium, it's a group of 3 commissioners. 3 commissioners will handle your assessment in case of certain eligible assessees, so that there is a less chance of appeals. So who are those fortunate assessees in whose case 3 commissioners will handle the appeal? First of all, let's try to understand the eligible assessees. The eligible assessees are as follows. First of all, foreign companies can also be called, always be called as eligible assessee, and all other non-residents can also be called as eligible assessee. Apart from non-resident and foreign company, non-resident and foreign company will always be called as eligible assessee. Apart from that, if there is a variation which arises due to TPO in transfer pricing, they can also be called as eligible assessees. So non-residents are always eligible assessee for the purpose of this section. Same for a foreign company. For others, if the TPO increases the income past a prejudicial order, then in that case, that assessee will also be called as what? Eligible assessee. Now in the case of eligible assessee, what happens? Generally what happens when the assessment is done, the AO will pass the assessment order, will give you the order, will tell you to pay the tax. But in case of eligible assessee, the AO cannot directly pass a final order. AO always has to pass a draft order and forward the draft order to the assessee. So in case of eligible assessees to whom dispute resolution panel section is applicable, the AO does not have the power to pass direct final order. The AO has to pass a draft order. After that, the draft order will be given to assessee. Within 30 days, assessee has 2 options. He can accept the draft order. If he accepts the draft order, then the AO will pass the final order within 1 month from the end of the month in which the acceptance is received by the AO. So if the assessee accepts the draft order, then within 1 month from the end of the month, the draft order will be within 1 month from the end of the order in which the acceptance is received, the AO will pass the final order and the assessment is complete. After that, if you are not happy with the assessment, you can file an appeal to CIT appeal or JC appeal as the case may be. But we want to go for DRP. Then you have to object to the AO and DRP. Then you have to file an objection that I don't accept to this draft order. I will object to DRP. Then the AO has to wait for the order or wait for the direction of DRP, and the DRP will pass the direction within 9 months from the end of the month in which the draft order is forwarded to the assessee. So it's very simple. If I am an eligible assessee, I have 2 options: either to accept the draft order. If draft order is accepted, then AO will pass final order, or I can object the draft order to whom? To the assessing officer and to DRP. After that, the DRP will pass the order, will give the direction within 9 months, and after that the DRP will give that particular direction to AO, and then the AO will pass the final order within 1 month. How will the DRP issue direction? DRP will consider the draft order, will consider the objection filed by the assessee, will consider the evidences filed by the assessee, will consider the report of the AO, valuation officer report, and many other evidences which are collected by DRP. Yes, before passing the order, the DRP will give an opportunity of being heard to assessee as well as AO. Now the direction of the DRP is binding on assessing officer. Whatever the DRP will say, the AO has to do that. But it is not binding on assessee. Assessee can file an appeal later on. Later on, when the AO will pass the final order, the assessee can file an appeal to ITAT. Definitely assessee can file an appeal to ITAT. Assessee is not restricted from anything. Yes, for AO it is binding. In DRP, there are how many people? 3 commissioners are there. If there is a difference in opinion, obviously the decision will be taken based on majority of them. This proceeding is also now faceless. It is done through a video conferencing plus one important thing, which is an interlinking with the search and seizure assessment. For search and seizure assessment, DRP option is not available. So DRP option is available for regular assessment, best judgment assessment, and income escaping assessment. It is not available for search and seizure. Be very careful. Now let's talk about specified domestic transaction. For certain specified domestic transaction, transfer pricing is applicable. Now, as I've told you earlier also, for transfer pricing, for international transfer pricing, there is no threshold. But for specified domestic transaction, transfer pricing is applicable if the aggregate value of transaction during the year exceeds 20 crore rupees. For international transfer pricing, there is no threshold. But for domestic transfer pricing, there is a threshold of 20 crore rupees. It should exceed 20 crore rupees, then only transfer pricing is applicable, otherwise not. Sir, why this provision has been brought? Under which domestic transactions are covered? Which are between what? ATIA, ATIB, ATIC, SSE or 10 double SSE or 115 BAB or BAE SSE. There is a chance for manipulation. How, sir? My one unit is under ATIA and another unit is non-eligible unit, not eligible for ATIA. We can play with that. How, sir? One unit is eligible for ATIA, one unit is eligible for 10 AA and another is not eligible. How? But how we will play? I will sell the goods at higher price. I am supposed to sell for 1000, but I will sell at 1500 because 1000 is also deductible for me. 1500 is also deductible for me, but for other person, 1500 will be allowed as an expense. So there can be manipulation. Similarly, for 115 BAB, BAE SSE, 15% is the tax rate for 115 BAB and BAE. I am 115 BAB SSE and my other entity is not a 115 BAB SSE. They are liable for 30% tax. So I will sell them goods at a higher price. I am supposed to sell at 1000 rupees, but I will sell them at 1500 so that I will be liable for 15% tax, but they will be eligible for 30% deduction. You cannot do that. If you do that, you will be liable for domestic transfer pricing. All the provisions of transfer pricing are applicable here. All methods will be same, etc. Everything is applicable here. Domestic transfer pricing will be applicable. Along with that, for 115 BAB and BAE, I have told you earlier that if transfer pricing is applicable here, then in that case, whatever is the excess amount on that, flat 30% tax is applicable. Flat 30%. So one unit is eligible for 115 BAB, another company is not eligible for 115 BA. I am selling for 2000 rupees, whereas the market value is only 1500. So extra 500 which I am selling for, that extra 500 will be taxable at flat 30% for 115 BAB and BAE SSE. I hope it is clear to all of you. Now, along with that, there is also some domestic safe harbor which is absolutely hopeless, not at all important for examination, but still we will see once. International safe harbor is very important. That is very big also. That is important. But domestic safe harbor, nobody is going to ask you. Sir, what is domestic safe harbor? Domestic safe harbor is applicable for two people. Again, it is optional. If you want to come, come. If you don't want to come, don't come. Nobody is forcing you. Domestic safe harbor is applicable to government company which is engaged in transmission, distribution, generation of electricity, or cooperative society engaged in procuring, marketing milk and milk products. So it is applicable for supplying of electricity, transmission of electricity, wheeling of electricity or purchase of milk or milk products by society from its member. Be very careful. This is only applicable when the society purchases from whom? From members. Then what is the safe harbor they have to show? For electricity, they have to show tariff which is approved by the appropriate commission under the Electricity Act. The law does not say anything. Income tax law does not say anything. 17% margin, 18% margin does not say anything. For international transfer pricing, they have mentioned margin for everyone. But not for domestic safe harbor. For domestic safe harbor, they are directly saying you have to show the tariff which is declared by the appropriate commission as per Electricity Act. I don't know what is that tariff. Similarly, for purchase of milk and milk product by society from its member, you have to declare the price which is routinely declared by the society in transparent manner and are available in public domain. So whatever is the price which is declared by the society in AGM, etc., on the notice board, etc., that price will be considered as what? As the safe harbor. So this is there since last 15 years. Nobody is going to ask you all these things in examination. Yes, international transfer pricing is important for exam. Be very careful with that. I have also made some practical questions on that for which I have shared the PDF. If you have not got the PDF, comment below. I will share the PDF with you. I'll share the PDF also. Now the last but not least, very important provision for examination, 94A. Notified jurisdictional area. So if I am in India and if I do any transaction with a person located in NJA, then what is the impact of that? First of all, what is an NJA? NJA is a location which the CBDT has declared or will declare, with which India does not have effective exchange of information. So whichever country does not share effective exchange of information with us, whichever country does not share information with us effectively, that country will be called as NJA. We will declare that country as an NJA. And if an Indian entity, if a person located in India or any SSE who is liable to tax in India is entering into a transaction with NJ, will be liable for this provision. What is the impact of that? That I will tell you in a while. First of all, what do you mean by person located in NJ? Person located in NJ means a person who is a resident of NJ. Or if it is not an individual, if it is a company, etc., then it has to be established in NJ, incorporated in NJ, registered in NJ. Or if it is a third country company, then it can be a permanent establishment of a person falling in third country. So, if a person who is a resident of NJ can be called as person located in NJ. A person can also be established or incorporated in NJ, or it can also be a permanent establishment of third nation. What are the consequences? So I am in India. There is a person located in NJ. I am entering into a transaction with them. First of all, we both will be deemed to be associate enterprise. Deemed, yes. Don't check the percentage. Don't check the criteria of 92A. Directly associate enterprise. Second, the transaction will be deemed to be international transaction. Directly deemed international transaction. Yes. Transfer pricing provisions apply. Third, if you apply the range concept and the number of items are less than 6, do you remember you have to take what arithmetic mean if the number of items are less than 6 in case of range concept, and in that you have to check at least 3% margin has to be there between both of them. So in this case 3% margin variation is also not applied. 3% margin is also not applicable. Fourth, which is not mentioned here but I have told you earlier, if you enter into a transaction with a person located in NJA or person located in a country where there is a low tax or no tax, then safe harbor rule is also not applicable. Safe harbor rule not applicable if you do transaction with a person located in NJ. Next issue, if you enter into a person located in NJ and if you want the deduction of the expenses, then you have to submit the documents and information as required by the income tax authority. Then only we will give you the deduction, otherwise we are not going to give the deduction. See, that country is not sharing information with us. So we will put some force and pressure on the SSC that you have to get the information from them. Whatever CBDT will ask the information, you have to get the information from them. Next, if you are receiving any money from NJ, you have to explain the source of that money. If you are not able to explain the source of the money satisfactorily in the opinion of the assessing officer, that will be deemed to be income. Last but not least, the most important point. When you make a payment to a person located in NJ, you have to deduct TDS at the rates in force or 30%, whichever is higher, plus surcharge if applicable and cess. Suppose you are entering into a transaction with person located in NJ and you are making some payment of royalty. By default, you should deduct TDS at 20% on royalty. But in this case, you will deduct TDS at 30% plus surcharge if applicable and cess. Actual rate of 30%, whichever is higher, if you enter into a transaction with person located in NJ. Then tell the other person located in NJ to file the ITR, to show the income, to show the tax as 20% and claim refund. Because tax is 20%, we have already deducted 30%. Tell him to claim the refund of 10 lakhs, 10% we will give the refund. Don't worry. We are not saying that we will take extra money from you. But while deducting TDS, we will deduct at 10% or we will deduct at 30% only. We will not deduct at lower rate. We will deduct at 30%. Now the most important question, is there any country declared as NJ? No. Only one country, one territory was declared as NJ, which was Cyprus in 2013. That is also withdrawn in 2017. So it's of no use. Practically, this section is of no use. But yes, in exam, they will ask you. Country X is an NJ, country Y is an NJ, country Z is an NJ. They can make this hypothetical stories in the examination. And they will test you, and they have been testing again and again this section in the examination. Be very careful. So this is what my commitment towards my transfer pricing chapter is completed. In full English, along with Hindi. I am recording both of them separately for all of you, dear students. So it may take some time for some chapters. So don't be impatient in life. Still, we are first in India to declare, to give all the things to our students. You cannot show me one single channel in the entire South India which will give you such kind of content in English. It is impossible. The effort which I am giving, nobody can work harder than me. Yes, people can be smarter than me. People can be richer than me. People can be more visionary than me. People can be better teacher than me. But nobody can work harder than me. That is something which I can commit to you. Nobody is going to be more hardworking than what I will be doing for you all till your examination, all my dear students. In the most efficient, in the most practical manner. A manner which will help you all. So take care all of you. Bye. See you soon with the next session. The next sessions will be on past RTP's compilation, which will be one of the most important sessions for all of us. Till then, take care all of you. Bye.